Unfortunately, even though the situation in the Middle East is very volatile, the market has gotten used to looking past events like these.
I think the market is just trying to find this equilibrium right now.
If I'm right that inflation gets down to 2%, then a 10-year Treasury at about 4.5% sounds about right.
I wouldn't be surprised if the 10-year does cross 5%.
You're going to see some form of yield curve control brought in to stabilize the bond market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a volatile week so far this week. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Together this morning with Lisa Abramowicz and myself is Anne-Marie Hordern. Your equity market on the S&P 500 is negative by about 1/3%. Under surveillance this morning, 24 hours of Treasury market volatility coming off the back of the worst day for the long bond since 2020. Boston Fed President Susan Collins weighing in saying this: the rising long-term yields imply some tightening of financial conditions, and if it persists, it likely reduces the need for further monetary policy tightening in the near term. That's where our focus begins, Bramo, this morning.
Except that what we saw yesterday in the market didn't necessarily have to do with Fed speak. It had to do with an auction that didn't work that well, a 30-year auction. There is a question about whether the Fed has lost control of the narrative, and that, to me, is really the story. Fed speakers can keep coming out again and again, Patrick Harker today, and yet the takeaway to me is that they've lost control and the market is just whipsawing around what they perceive to be inflation.
Lisa, it's easy to blame CPI, but I'm with you. This was about supply. It was about a 30-year auction, Anne-Marie, that came in really, really soft.
Yeah, it did. And I think everyone's going to point the finger at Washington this morning for a number of reasons. They don't have a Speaker of the House, but also what's going on in the Treasury market. When you look at what the Congressional Budget Office continuously stresses and puts out, our interest payments are growing. In 28 years, the biggest line item on our federal budget is going to be paying off our interest, more than entitlements, more than Social Security. That's a big problem.
It's a massive, massive problem. We'll be talking about it through this morning. Also need to talk about bank earnings kicking off. JPMorgan leading this hour, followed by Wells Fargo and Citi. The KBW Bank Index down 24% this year, failing to recover from the SVB collapse back in March as new regulatory proposals, unrealized portfolio losses and rising bad loan write-offs weigh on banks. The write-offs, Lisa, I've got to say, big focus going into JPMorgan, Citi and Wells later on this morning.
And it's not necessarily because of an existential question around the banks. It's much more simply to understand where we are in terms of credit heading to small businesses, to consumers. It's sort of the macro question rather than the micro existential, will banks collapse question that we had back in March. That seems to be kind of not in the works right now.
Far more interested in Bank of America next week.
Agreed.
Maybe than JPMorgan. That stock just absolutely hammered so far this year.
And they cater to a broader base of small businesses. It seems like there's been attrition of the lower income players, both in the consumer space and the business space when it comes to a lot of the bigger banks. Which banks are most leveraged to some of these smaller players, which is the reason why I'm actually very interested in PNC coming out at 6:30 this morning.
The JPMorgan about 43 minutes away. Also need to go to our top story all week, dominating the headlines. Israel calling for an evacuation of the roughly 1 million civilians in Gaza City, indicating a ground invasion could be on the horizon. The UN warning it's, quote, impossible for such a movement to take place without devastating humanitarian consequences. Israel's military has stationed as many as 300,000 personnel outside Gaza, while Hamas has said it will begin killing hostages should a ground invasion come. How difficult are the next couple of weeks going to be?
Oh, it's going to be incredibly challenging. And what you see from the United Nations is they're saying we cannot move this quickly in terms of moving Palestinians, moving everyday civilians out of Gaza, especially in the north. So this is going to be incredibly challenging, and the images are going to be horrific.
And it's igniting so many passions around the world. Today, Hamas called for a day of rage. There are a lot of places that are closed. Police presence is very high around the world. When you talk about, is this contained? Well, maybe this is contained in terms of just it hasn't escalated into a regional fracas. But globally, this is percolating out onto the streets into every city around the world.
Greg Valliere coming up a little bit later on this morning. We'll catch up with the man from AGF Investments in about an hour's time. With us around the table this morning, Greg Bowdle, Head of US Equity and Derivative Strategy at BNP Paribas. Morning, Greg.
Good morning.
What a week. What a week in this bond market. This bond market seems to really spook equity investors. I'm not sure we've had to deal with this for a long, long time. You get a soft auction on the 30-year. What do you do with that?
Well, I think the interesting thing is that it has weighed on the equity market, but to say it's spooked equity investors, it hasn't injected any volatility into the market at all. So we've still seen an environment where it's been relatively benign. We've had some decent down days from the S&P, but they've been isolated pockets, down 1.5%, flat, rebounded. We haven't had real volatility injected into the market.
People want to see stability in treasuries. I've been asking a question. When they say stability, do they mean lower yields or smaller moves?
Smaller moves, sideways moves. I think for the equity market, given the growth backdrop and some of the strength that we've seen recently in the data, then a lack of volatility from the fixed income space might be enough to see equities perform in the short term.
But this, to me, is a fascinating point. It's not saying that when yields bounce around like penny stocks, that's actually a problem for stocks. You're just simply saying, well, if they stabilize, then stocks can rip. And this seemed to be what Bank of America Michael Hartnett was saying. As long as 10-year yields, 30-year yields don't breach significantly above that 5% mark again, we will avoid the worst case scenario and things will chug along. Do you agree?
I think it depends whether we're talking about a short-term tactical view, 1 week, 1 month out, or whether we're looking a little bit further out the time horizon. What matters as we go over the back end of the year into next year is really the effect of those higher yields on the real economy. If we start to see a macro slowdown from the effect of higher rates, then I think it can be a much more difficult environment for equities. Tactically, in the short term, I think a lack of a move higher in rates is enough to give some relief to equities.
Do you feel like, in some ways, people are getting more confidence in risk appetite simply because nothing has broken yet amid all this volatility?
Yeah, absolutely. There's this kind of self-perpetuating cycle that when you have negative news flow and the market doesn't respond, behaviorally, the right thing people think to do is therefore to buy on dips. And we've certainly seen that this year. When the market broke up through 4,200 in June, we saw huge inflows into the equity market. And we think that was a lot of capitulation in terms of some of the more recessionary bearish narrative. So, ultimately, behaviorally, being underweight stocks has been the more difficult position. And that's why people, we think, have put a lot of money to work. But ironically, that increases the downside risk a little bit from a positioning perspective.
Is the Fed done?
Our view is that the Fed has put in its last hike, but obviously it depends what happens with the data, right?
So December's a live meeting. Morgan Stanley think they're done, but ultimately they still say that December's a live meeting. November's dead. Ultimately, the Fed speakers have pushed cold water all over that. Do you agree with that?
I think that, there's always risk, depending what happens with the data, depending what happens with oil, depending what happens with inflation. There's always risk that the Fed have to go again. But it's not our base case.
When you say that there are all these risks, and it's a pretty wide parameter, especially right now, Bloomberg Economics came out and they said there is a risk that if Israel does go directly after Iran, oil prices could go up to $150 a barrel, and you could get some sort of significant recession that takes $1 trillion off the global GDP. How do you plot the potential for something that could be a scenario, but is an unclear likelihood? How do you frame out what we're all wondering, these sort of existential questions?
Yeah, frankly, that's the problem that equity investors have been dealing with all year. It's the reason why people, including ourselves, have been too bearish on the market, is that we've seen a slowdown coming and it hasn't manifested. So ultimately, the thing that we've been focusing on is trying to set up trade ideas, portfolio construction, such that you can weather a more benign environment for equity, but get exposure to what we think are some cheap tails to protect yourself from the more recessionary environment that, even absence that type of evolution of events, we still think a recession is coming in Q1 regardless.
What are you looking for in the bank earnings that we're starting to get, I believe, in about 22 minutes?
Yeah, the bank earnings are going to be super interesting. One thing empirically, in an environment historically, when yields rise and yield curves steepen, the banks have been the best performing sector historically in that environment. But we know that hasn't really been the case this year, given what happened in Q1. I think one of the most interesting things coming into this quarter is that there's an absolutely massive volatility premium in the bank stocks. So clearly the market is concerned about what they're going to hear from the banks. The question for us is that concern more related to something idiosyncratic for the banks, their balance sheets, or is it more a reflection of a slowing in the macro and something we can read to the broader market?
What have we learned from how the bond market plays into what happens with bank stocks? Ultimately, the high yields hurt them, right?
Yeah, the disorderly move in rates, the volatility, the nature of the kind of dislocation we've seen in there isn't something that they've been able to digest.
How much is it, are you looking at some of the charge-offs that we've been getting and that we're expecting to see with respect to credit write-downs? How important is that from a macro perspective to paint your view of credit and the impulse into the economy?
I think it's really important because our narrative into the back end of the year is that the economy will slow, that the consumer is at risk, that the effect of the tightening the Fed has done will be making its way slowly into the real economy. So far, we haven't seen a ton of evidence of that manifesting, and this is one of those data points where we will look to that. And if we do have a negative surprise in terms of some of the detail of the bank earnings, I think that is something that is going to weigh on the market.
What's your highest conviction call right now?
Highest conviction call for us right now is to be short the consumer discretionary names. Not necessarily through this earnings season, but looking for any type of relief rally that we see through earnings for next year. We just think the effect of the slowing economy, the higher rates, that's one of the kind of subsectors of the market which we just think is most at risk going into Q1 next year.
LVMH called the top.
Potentially.
Right? Is that what you think?
We'll see.
I'm looking for indications. I don't really see it outside of, say, some companies saying things are a little softer.
No,
Do you see it in the data?
No, I think that's one of the things that we haven't seen this year. It hasn't really started to manifest yet. But the issue with slowdowns, recessions, is that they can start quite slowly and then accelerate pretty quickly. We think the effect of higher rates is just something that will mechanically have an impact on the consumer. We know we've had this story of excess savings that we're working through. So I think the fact that this has taken a little bit longer than everybody, including ourselves, thought it would to play out doesn't mean those effects are not going to be there.
Greg, thank you, sir. Greg Barrow there of BNP Paribas. Let's go through the bond market, Bramo. 30-year. The 30-year at the moment has a yield of 4.78. The 30-year yesterday had a move of almost 20 basis points higher, and it's still below, 27 basis points below where we were a week ago Friday intraday.
By one measure, it was the biggest one-day pop in yields on the 30-year going back to the height of the pandemic in March 2020. This is the type of volatility that we're talking about because even though the U.S. sold 30-year bonds at the highest yields that they have going back to 2007, they couldn't attract the buyers. One soft auction after another. It raises a question, is this a buyer's strike that is temporary or something that is more permanent and structural in nature?
Thinking of Dalip Singh of PGIM, who spoke to us recently and talked about the loss of predictable buyers. The price-insensitive buyer has taken a back seat. Are we still trying to figure this out?
100%. This is still a question mark. We don't understand why the market has been bouncing around to the degree that it has. People have different theories, and people are solidifying on a sense that maybe we're just topping out at some sort of level and that this has to do with the Fed. At this point, it doesn't really have to do with the Fed. It has to do with other things too. Yes, the Fed, it's a part of it, but they're kind of losing control over the long end, and that's why we heard Michael Schall say maybe they'll try to get control. A very controversial idea. I got a lot of pushback yesterday as a response to this, and yet these are some of the discussions that you're hearing in the market right now.
There's a price for everything. I was speaking to Greg Peters of PGIM yesterday, and we tried to work through some of these issues. And the bottom line is basically this. Why would you want to take on a longer dated maturity with less yield in an expansion? Until we get really soft economic data, people aren't going to be willing to do that. And ultimately, maybe that's why we're seeing the curve disinvert as much as it has done over the last month or so.
And the fact that we've seen better than expected data, you asked just now, Greg Barrow, have you seen any signs of that consumer softening? The answer is not really. If you take a look at all of the different parameters in economic data, it has been stronger than expected again and again. The fact that we haven't seen even higher yields, a lot of people say, is just the risk appetite has really waned in light of the conflict, and that's dampening yields that otherwise might be substantially higher and substantially more disruptive.
AMH, we were talking about this in the last couple of weeks. Are we very close to officials in Washington waking up and checking the price of a 10-year yield every single morning?
You think so, right? When you're sitting in New York, but not really. I mean, we still don't even have a Speaker of the House. The issue is, and Michael Shaul talked about this yesterday, is there needs to be more fiscal discipline. That's reining in spending, but also increasing taxes. When you look at the makeup of Washington right now, neither of those things seem to be possible in a bipartisan way.
And basically what you're hearing from investor after investor is they're not going to get their act together. Have they ever gotten their act together? The discussion isn't even on the table. So if they're not going to get their act together, what's the new term structure? What do we have to adapt to? And note after note has come out and said, you know, we could probably live with this. As long as it doesn't get too out of control, we can live with this.
What's the comedian say? Aren't you embarrassed?
Aren't you embarrassed?
Which comedian's that? Sebastian Maniscalco?
Yes, the Italian.
So. Aren't you embarrassed? I mean, that's how I feel about Washington, D.C. right now. Like, they don't seem to be embarrassed at all.
Not at all.
And it's the sausage making in real life.
It's not a sausage. It's bolognese.
Sausages taste nice sometimes, right?
Exactly.
There's nothing tasty about this.
Not at all.
Coming up, 6:30 Eastern Time, Gerard Cassidy of RBC Capital Markets counting it down to JPMorgan earnings this hour. From New York, good morning.
Iran has had a long relationship with Hamas, and Hamas wouldn't be Hamas without the support that it's gotten over many years from Iran. Having said that, when it comes to this specific attack, right now, as we speak, we haven't seen direct evidence that Iran participated in or helped plan the attack. That doesn't mean that it didn't, we just don't have the evidence to show it.
That was Secretary Blinken, the US Secretary of State, speaking to ABC from Israel. The latest on the Israel-Hamas war. Israel calling for an evacuation of all civilians in Gaza City. The United Nations get 24 hours to move its staff from nearby areas, indicating a ground operation, Lisa, could be coming very soon.
And the UN saying that it's going to be very difficult to move 1.1 million people out of Gaza City in 24 hours, asking for more time. There is a bigger question here, which is how do you protect the maximum number of civilians as we see an increasing incursion that has demolished entire parts of the Gaza region? And this has been something that it has an escalating feeling, and we heard that from Tony Blinken yesterday, to basically use some discretion and restraint at a time of incredible conflict.
Joining us now to discuss is Paul Lips, the Professor Emeritus at Tel Aviv University. Professor, wonderful to catch up with you, sir. Can you run us through the scale of what you imagine is about to play out?
So I think there are a number of alternatives. Firstly, I think one has to remember that part of what might be said publicly is not necessarily what is actually going to be implemented. So I think one has to be fairly careful of taking everything that's said publicly as being what the final word is. But I think what has happened here is that this is a different kind of conflict that any conflict that Israel has ever faced. This is defined very much in terms of the Holocaust, where there was a real attempt to wipe out the whole of Israeli society. So in that kind of situation, and I know it's kind of maybe hard for America to imagine what it is from the Israeli side, we actually believe that if Hamas had managed to get a little bit further into the country, it would have been the end of the state of Israel. So we're speaking about a war of survival. We're not speaking about a war which is only about, who gets killed and who doesn't get killed. It's much greater than that. And in that context, I think the general opinion of Israeli society is actually saying, well, we're going to have to show Hamas once and for all what's going on. Now, what is Hamas? Hamas is the accepted political body of the Gaza Strip. 2005, 2007, there were elections, and Hamas was invited, told by the public that they should be the government in power. And that government in power has said very, very clearly that they're determined to wipe out the whole state of Israel. I have in front of me, by the way, the documents of the Charter of Hamas of 1988, which is the basic principle of what Hamas believes in. And they say very, very clearly, and I won't bore you with all the sentences there, but basically they say there that our goal is to wipe out Israel. So we're fighting for a war of survival.
Well,
and in the war of survival, certain very tough things are going to happen.
Professor, there is also a question about Israel's survival without the international support, and there's a question of what kind of international support Israel could lose if some of these images escalate and a significant civilian toll is exacted on the Palestinian people. So how do you understand some of the discussions, the proclamations that you say take them as simply messaging, not necessarily the final word? How do you understand how Israeli officials are understanding trying to limit civilian casualties while also preserving their survival?
That's a very difficult situation. In war situations, unfortunately, innocent people are killed. And if we look at the end of the Second World War, we know that millions of people in Dresden were wiped out. They therefore broke the accepted regulations of war. So Israeli society would want to remain within the broad acceptance of what should be done and what should not be done. Until now, the approach has always been in Gaza, telling people in certain buildings that they will be attacked and that they should move out of the building, because we have not wanted to kill vast amounts of people. Certainly from my point of view, that would be the last thing I want. But I would want to say that in the war of survival, we would like to remain within the accepted regulations of what happens in a war, which, by the way, very few countries have ever done. So although there are these regulations, very few countries actually abide by it, particularly when it's a war of survival. And therefore, I believe that we would try as much as possible to remain within the regulations until it seems that we will find ourselves in a situation in a few months' time being under attack again. And we don't want this to happen a second time. So I think the Hamas has to bear the burden of responsibility. And when we're looking at any war situation, we have to ask who started. And if you start a war and you try and kill innocent civilians, which happened in Israel, then unfortunately the result on the other side might be problematic. I'd just like to say something about support. I can never remember, and I've been in this realm now for 50 years, I can never remember the level of support which Israel has received from some of the countries, as has been the case. The the presentation a few days ago by President Biden was without doubt the most important statement of American support to Israel. And I hope that that support will remain. And at the same time, I hope on our side, we will be as careful as we possibly can not to cause wanton damage.
Hamas said this morning that 13 hostages were killed, Israeli and foreigners, due to Israeli airstrikes. Is Israel going to take the hostages into account before they start what is looking like a ground invasion?
Well, I just want to say something about ground invasion. It isn't always what one expects it to be. It can be a whole lot of in-between actions as well. So it's not just the mass ground invasion as sometimes people imagine. Look, we've got a major problem here. We want to destroy Hamas because Hamas has designated its goal as destroying the state of Israel. And at the same time, we have hostages there. So this is always a very delicate kind of situation. I do not take Hamas's comments all that seriously. We found in many cases they've given information which is totally incorrect. Be it as it may, we are caught in a very difficult situation. And one point of view would be, just let's give in to all the Hamas demands, and then we will get our hostages back. And that would mean that in a few months' time, we're once again in the terrible conflict. Or do we find something in between? And I won't go now into the possibilities, but the possibilities do exist where I think we can save, hopefully, most of our hostages, while at the same time, perhaps causing damage to Hamas, the terrorist organization, which would not harm the wider population more than necessary.
Professor, thanks for your time today. Paul Lips there of the Tel Aviv University. The latest, if you are just tuning in, Israel calling for an evacuation of all civilians in Gaza City, giving the United Nations 24 hours to move its staff from nearby areas. Strong indications this morning of an impending ground operation. This came from the UN, the response from the United Nations. The UN considers it impossible for such a movement to take place without devastating humanitarian consequences. Amory, it goes without saying, this is a really delicate moment right now in the Middle East.
Incredibly delicate. And Secretary Blinken said yesterday how Israel does this matters. He said, we democracies distinguish ourselves from terrorists by striving for a different standard. It's going to be incredibly difficult to get these people out.
It's also going to be incredibly difficult, I think, just for cities worldwide as everyone deals with the very heightened emotions. And this is something that we can feel. This is not a conflict that is isolated to one region. Mm-hmm. This is a conflict that goes deep.
We'll stay on top of the story through this morning. For Wall Street, the focus on banks. JPMorgan about 20 minutes away. Joe Cassidy of RBC Capital Markets is going to be joining us to anticipate the numbers just around the corner and look ahead to next week as well with Bank of America results on deck. Live from New York City, this is Bloomberg. Snapping a 4-day winning streak on the S&P 500 in yesterday's session. Your equity market this morning, the follow-through negative. On the S&P, we're down by 1/3 of 1%. On the Nasdaq, we're off by 1/2 of 1%. This week, Lisa, what a wild ride so far this week.
And honestly, trying to get a message is basically like trying to read something out of the clouds. Frankly, it's been so difficult at a time of such diverging pressures, whether it's geopolitical risk or just this feeling. Data comes in hotter than expected. Some people are saying that the rise in yield yesterday was because of CPI. Okay, right. We didn't see the move until after the auction. So I kind of reject that. I think there's a lot of stuff going on that's technical.
I think the chart speaks for itself.
I think so,
you look
too.
at CPI, yields start to climb a little bit and then bang.
Exactly. Thank you.
Auction happens, and that's when it starts to spook equity investors as well.
Did people really care about PPI? Did people really care about CPI? Or all of a sudden were people saying, wait a second, technically this doesn't feel right. We don't feel stable, so we can't really get in, and we're going to stay on strike.
People are confused by what is happening with the auctions. And I think they're spooked by it. You see a lot of money come into the market, a lot of treasuries, then you get a really weak auction, even with yields at the highest since something like 2007 for a 30-year issue. Demand just isn't there, Bramo. Demand just is not there.
And then you also have what you have with banks not really having the appetite to really come in with any heft and pick up the slack. So they were forced to have 18% of the auction yesterday. That's not that significant, but they were forced to. They would not have wanted to pick this up.
I keep saying this, even with yesterday's move, yields up aggressively. We're still 27 basis points below where we were last Friday after payrolls on that cycle high. Your 10-year, 461.65, yields lower by about 8 basis points. Let's finish on foreign exchange. Yesterday, yields up, dollar stronger against everything in G10. This morning, the euro back at 105, but just about unchanged here, Bramo, at 105.23.
What we're watching today is definitely going to be bank earnings. It's going to be really important. Any minute, we're supposed to get PNC earnings. We will bring that to you when we get that. I personally am interested in that, although everybody else is looking to JPMorgan in about 15 minutes' time, followed by what we're expected to get from Wells Fargo around 7 a.m., Citigroup around 8 a.m. Throughout the day, we'll get analyst calls, 8:30, 10, and 11 a.m., respectively. 10 a.m., we are getting that Facebook Live presentation from the UAW President Sean Fain, even after the surprise strike, even after Ford said, we have offered what we can offer, forget about anything additional. What more are they going to say? I mean, this is really a question. At a certain point, what do they want? I don't know.
It felt like an escalation yesterday. It really did. We're going after the F-Series trucks, and Ford basically turning around and saying, that's it, you've had your offer. These are the parameters, need to work between them.
And I couldn't tell whether it was an escalation of emotion or an escalation of tactical planning. And I think maybe we'll get a better sense of that in the days to come. And 10 a.m., John's favorite, the University of Michigan Sentiment
Didn't
Survey.
get the call.
No, not this week either. Every single time we have this, I'm going to ask you, did you get the call?
I will be so happy when I finally get that call.
And you are going to give them ridiculous estimates.
I need to work out how to record it. I just need to work out how to record it. I'll give honest estimates.
Will you?
Yeah, absolutely.
Are you going to give like
where I think inflation is going to be in 5 years?
3.1%.
Like 3.2567, something like that.
9, 10.
Yeah, see what they say back to
Okay. Anyway, we get that at 10 a.m.
Looking forward to it. We'll get earnings this hour as well. Lisa talked about PNC. JPMorgan coming up in about 15 minutes' time. Let's get to our chief Wall Street correspondent, Shanali Bassett, with us around the table here in New York. Morning, Shanali.
Good morning.
What are we looking for?
We're looking for how much net interest income is finally facing some pressure. You're looking at an expectation of it for it to decline from what was record levels that you saw a quarter ago, that boost they got from First Republic. But even behemoth JPMorgan is facing some pressure on business lines like trading as well. So the overall picture, what does it look like for things starting to turn around into next year? Citigroup analysts estimate that it'll be the second quarter of next year before you see net interest income start to rise at a lot of these banks. Remember, loan demand has been pretty muted. A lot of questions about how much capacity consumers have to take on more loans, especially in the higher interest rate environment. Credit cards are being maxed out at this point in time. How much does that start to feed into credit quality as well? For behemoth JPMorgan, how much are they willing to take that pain when it comes to credit losses? Because it will be a bellwether for the rest of the industry.
Let's talk about that. So of the big names, JPMorgan, Citi, Wells Fargo, Bank of America, all of them combined, we're going to hear this number potentially posting roughly $5.3 billion in third quarter net charge-offs. For our audience who are following this, who aren't familiar with the banking jargon, what are net charge-offs? What does that number mean?
It is when loans start to sour. People have a harder time paying back loans. And listen, that $5 billion, yes, it looks scary. It's $5 billion. It's the worst since the second quarter of 2020, the start of the pandemic. However, for banks, it's a calculus. Are they making more money than they're losing? And if they're lending into a market where they're willing to take $5 billion worth of losses off of those loans, that's not a bad sign, is it?
Well, and I was thinking about permacrisis yesterday in your conversation, how we're all kind of conditioned to the banks are going to fail rather than it just isn't going to be as profitable, and the sort of calculus that Sonali is talking about. That's what I was thinking about.
Existential crisis on the one side, profitability issues on the other side. Bank of America in the middle. Whenever Treasury sell off, that bank suffers. What's happening over at B of A? Never mind JPMorgan in 10 minutes' time. Bank of America next week. What's going on there?
Let's take JPMorgan versus Bank of America, because it makes me laugh a little bit here. Timing the market in Treasuries. You had Bank of America taking in deposits, plowing those into Treasuries when they were still at interest rates sub 0% or so. And now what you have is Bank of America holding all these bonds that they bought more expensively. They have sold off, and it is weighing on the stock, and it's weighing on the stock more than any other big bank, just for investing in the U.S. government.
Well, and this is something that they're all going to be dealing with. The other flip side of this is, when are they going to have to start paying some of their depositors a little bit more? Because I can tell you, as a banking customer with a major institution, I am not seeing it in my checking account, my savings account either. A lot of people aren't. Do people protest? Is that inertia starting to change when you're getting 5-6% elsewhere?
They're certainly protesting other things, but that 1.1% savings rate that you're still getting at these big banks, you have to get into the promotional CDs if you want that higher rate, or a fintech bank, SoFi, or even Marcus, where the rates are much, much higher, because they still want to bring those deposits in. But Bank of America and JPMorgan are still saying, we don't need your money yet. We have plenty of money, and we are still figuring out ways to deploy it because we don't know. Jamie Dimon has been weighing that risk of rates going to 7%. And so is this the point to get into the market more, if that's what you believe the risk is?
I think we've got to make a really important distinction. There is a difference between a CEO of a bank worried about rates going that high and preparing for that, basically making sure they're insulated from it, and a bond market strategist coming out and saying, Bramo, we're going to 7%. We're going to 7% on a 10-year.
I mean, and then he was asked later by Bloomberg, by Emily Chang, could you see 8%? He's like, sure, we could see 8%. I mean, this is like, why not? Where are we going to go? 10, exactly.
Somewhere Bob Michael's just like this. Please make it stop. Please make it stop.
Why? Just stop talking. At this point, though, there is this feeling. He's just saying we're just absolutely bulletproof. And that's really the message that he was trying to send,
but
not a
that
projection.
kind of preparation has really prepared him to really buck the pain that Bank of America saw. He didn't time the market per se, but he did avoid that risk of rates going much higher.
So true. Sonali, stay close. We're going to break down these numbers together in just a moment. Joining us now is Gerard Cassidy, the head of US Bank Equity Strategy at RBC Capital Markets. Gerard, wonderful to catch up with you, sir, every quarter to do this. It always is. What are you looking for from JPMorgan and the team in about 8 minutes time?
John, it's a great stock to look at, a great company to look at for a number of reasons, because the read-throughs are in all the different banking businesses. As you know, JPMorgan's a very diversified revenue company. And so we're going to be looking at the consumer business lines. How are they holding up? Did they grow much this quarter? Looking at the levels of charge-offs that you guys just talked about. On top of that, we're going to look at the investment banking activity. It's one of the premier investment banks as well. And then you're looking at wealth management. They have one of the premier wealth managements. And then, of course, we're going to be looking at that net interest margin and net interest income, and to see the effects of rising deposit rates on those line items.
Jared, just on the bad loans, the economy looks good on the headline numbers. What are you actually looking for with regards to how much money these banks will set aside to cover those bad loans?
I think we're going to be surprised to the positive side, John. I think what you're going to see is the provision, to your point, what money is being set aside. We have the new accounting rule that went into effect January 2020, and that's called CECL, Current Expected Credit Loss Accounting. And they have to look through the cycle in preparing for these potential losses. And so I think with this quarter's third quarter real GDP number coming in most likely better than expected, maybe there's a little bit of a backing off. But to your point, I was just looking at our model. And if you go back to 2019, 2020, this company was charging off just over $5 billion of loans every year. That number dropped in 21 and 22 to less than half of that, or about half of that. And so what you're seeing today is a normalization of credit. So even though it's going higher, this is where we were pre-pandemic.
I'm going to feel kind of bad after asking this, Gerard, because on one hand, it's always kind of nice when you see less risk. On the other hand, it's less profitable. And on one hand, you could say, okay, fewer charge-offs means that the economy isn't doing so badly and that the loans are safe. It could also mean that they're not banking with the riskier and also more lucrative clients. How much is that part of the story and challenges some of the profitability and ability to capture yields at these higher levels?
Lisa, a very good point. And they have de-risked their balance sheet. Following the financial crisis, as you guys all know, the banking industry, the big banks go through an annual stress test. And as part of that stress test, there's been a de-risking of the bank's balance sheets. And the shadow banking industry has stepped in more aggressively and taken on those risks. So it's a risk reward that Jamie Dimon, Brian Moynihan, all the CEOs do with their banks. They measure the level of risk versus the profitability. And the industry today is far less risky than it was in 2006.
Given the fact that there is less risk and also less potential for profit, they keep complaining that the private debt and equity players are eating their lunch. There is a question about what's baked into the price. If there are materially lower charge-offs, if they do show much safer business models, will that be good for their stock or bad for their stock?
That's a great point. And we really have to go through the cycle, because if this industry, led by JPMorgan and all the other bigger banks, can demonstrate that we can get through a traditional recession without having dividends cut, without having depreciation of book value, they will then get revalued higher, almost similar to utilities, not as high as utilities, but they may turn themselves into financial utilities because of that safety that they can get through a recession without having dividend cuts. So you're right. Though the profitability could be less, there could be an upward revaluation because it's safer to be in the bank stocks than it was in previous cycles.
After the collapse of several lenders, Gerard, earlier this year, what you hear from Washington is all these U.S. regulators want banks to add more cushion to their capital requirements. That's expected to be coming. How are these banks preparing for that?
What you're likely to see is that they're going to lower their size of their risk-weighted assets. They're going to mitigate some of that through downsizing different lines of businesses. But these rules, as you know, are probably going to start being implemented in the summer of 25 over a 3-year period. And so the way they're going to raise this capital is through retained earnings. And so they'll shimmy down a bit the balance sheet. But on the other hand, they'll be growing profitability through the next 2 to 3 years, and that will build up the capital to get to these numbers. And you're right, the regulators certainly want more capital. They're likely that they are going to get it, and the industry will be able to reach it. We're not worried about that, but the profitability will be affected.
Where does that leave capital returns, Gerard?
John, good point. Once we get to these targeted levels on capital, the capital returns will be very robust, because typically, as you know, the industry grows earnings at a rate where they cannot redeploy it effectively on an organic basis at returns that investors want. So as a result, they have to give it back through share repurchases and dividends. And once we get to these new capital levels, which we think the industry will get there by the end of 25, then you're very likely to see the industry or the big banks give back anywhere from 70 to 75% of their earnings in dividends and buybacks.
What a year it's been for this industry. Gerard, stay close. Gerard Cassidy there of RBC Capital Markets, sticking with us to break down JPMorgan results. About 3 minutes away. JPMorgan year to date, higher by 9%. Lisa, Bank of America, down by close to 20%. The outperformance, the relative performance between those two names this year has been remarkable.
I mean, Sonali nailed it with the idea that they have huge portfolios of treasuries, restricting their ability to lend, and they're more highly levered to smaller businesses and to consumers than JPMorgan. So it raises this question, with these earnings, does Bank of America have a bigger chance of surprising to the upside, frankly, and a lower bar to beat than JPMorgan, the fortress diamond?
Which is kind of what Gerard Cassidy said, right?
Exactly.
That maybe the bar here, Sonali, is a little low.
Yeah, they're trading most expensively from a price-to-book basis, more than any other bank. They're trading at 1.5 times book value, while every other bank except Morgan Stanley is below. If you can imagine, Bank of America at 85% of book value, they say when you're trading below book value, you're burning at value every day you're alive. And you can't imagine that from the biggest banks in the country.
Sounds brutal, right?
It's like, I hope that I'm not burning value every day of my life.
Bank of America, a real struggle. JPMorgan results coming up next. Your equity market negative on the S&P. We're down a third of 1%.
The rise in long-term yields implies some tightening of financial conditions. And if it persists, it likely reduces the need for further monetary policy tightening in the near term. This reinforces my view that we're very near and perhaps at the peak federal funds rate for this tightening cycle.
We're close, probably at the peak cycle rate. Susan Collins there Boston Fed President weighing in on the bond market sell-off we've seen over the last couple of months. Big moves we saw again yesterday at the long end on the 30-year yield following that soft auction. The 30-year this morning down about 8 basis points. Got some Wells Fargo numbers for you. Revenue coming in at $20.86 billion. The estimate, $20.16 billion US dollars. Shonali working through some of these numbers. Shonali, your thoughts?
Yeah, I mean, we knew that this was going to be a tougher quarter, and to the point that you're making here, they're just above estimates on revenue figures. That is a good sign because we're looking at things to hold up here. Net interest income coming in at $13 billion. That is above estimates as well, which shows you that Wells Fargo is lending into this environment. They are capturing that benefit of higher interest rates. The efficiency is still above 60%. Now, that efficiency number is an important one to keep a handle on because we're looking at job forces coming across these banks and what it looks like in a very pressured profitability environment. These also have large real estate footprints when you look at Wells Fargo and Citigroup and JPMorgan. So they may want to get a handle on that as the months progress.
The third quarter EPS 148, the estimate was 125. We talked a lot about provisions for credit losses. This is the number over at Wells Fargo for the third quarter, 1.2 billion, the estimate 1.33. How important is that number going to be over the next week? Numbers from Wells, Citi, Bank of America, JPMorgan.
It's proving what analysts are saying, that the provisions that we've seen are probably the bulk of it. All of the future economic pains that we see, maybe you've already seen those in the numbers. Should they think things get worse, the question in the calls will be whether we are going to see even more pain should the economy turn more, or are they already baked into the existing provisions?
We also see that third quarter net charge-offs came in also slightly below expectation, $864 million versus the estimate of $865.7 million. There is a question, though, about whether they're making fewer loans. Yes, they might be having fewer charge-offs, but we did see that with Wells Fargo coming in with fewer loans being underwritten than before. How much are people caring, or are they liking the caution and really liking that net interest income just keeps beating?
Listen, there's a sense that things can get much worse before they get better. And so that caution right now is being rewarded in the market. They want them to make money off of loans, but as we know, this interest rate story has been a real double-edged sword. They want to see the banks getting out of this period unscathed. Beat on those estimates, beat on those charge-offs, beat on those net interest income figures, and that's enough in an environment like this. Wells Fargo is also faring a little better than some of the other banks, even Bank of America from a price-to-book basis in some regards. So you do see a little bit of optimism into Wells Fargo, which you remember just a couple of years ago was a very, very, very unloved stock. The turnaround story at Wells Fargo is taking storm.
The stock at Wells up by 3%. JPMorgan drops. Let's work through the numbers together. We'll start with the investment banking revenue, then turn to trading revenue. IB revenue comes in at 1.61 billion. The estimate 1.48. Fixed sales and trading revenue 4.51 billion. The estimate 4.36. Break it down into equities. Sales and trading revenue there 2.07 billion. The estimate 2.27. That's mixed there, Shonali. Break that one down for us.
Which one were you talking about? Sorry.
Just compare, say, fixed sales and trading to what's happening in equities over at JPMorgan.
Listen, these investment banking, this is a pretty clean read. At the end of the day, when you look at it, their investment banking revenue coming in a little above estimates, those fixed sales and trading numbers, they have the biggest fixed income trading business on Wall Street. For it to come in at 4.5 versus $4.3 billion, it's not a humongous beat, but it is a beat at a time when we expected trading revenues to be meaningfully suppressed. Now, JPMorgan was supposed to be raking in the money from the lending businesses that increased First Republic business, but for them to show numbers in those core institutional businesses that are better than expected is a really decent sign because it's telling you that they're making money both from the institutions as well as from the consumer. Now, the other thing about that, to the point that you're getting at, the reason that fixed sales and trading number matters so much is the volatility in the market. There's a question of whether it's stifling or whether it's making the banks some money. And JPMorgan is showing you it is making the banks some money.
Getting some commentary from the C-suite. Let's start with Wells Fargo. Seeing the impact of a slowing economy. This is how Jamie Dimon puts it over at JPMorgan. Consumers are spending down their excess cash buffers. US consumers and businesses generally remain healthy. Those two things can be talking to the same thing. Things are slower, but they're still healthy.
And by the way, that's actually a little more positive than what you heard from Jamie Dimon earlier in the year. He told you that you were potentially facing a cliff in the U.S. consumer at the end of the year. He used the word cliff. And so for him to say slowing down is not saying that things are drying up and stopping. He's saying the economy is trucking along, but it is slowing down as we've known. And the numbers are showing you that they're still making money. The returns on equity of 18% are higher than expected. This is a very profitable bank, to be very sure.
Coming into these numbers, we had a big interest in provision for credit losses. I'll give you the number for the third quarter for JPMorgan, 1.38 billion, the estimate 2.49. That's a big downside surprise, Sonali, for JPMorgan on that front.
It's showing you that some of the worst has been baked in. And you always see this from JPMorgan. Conservatism, conservatism, conservatism. Set the bar low, beat expectations. You see that with earnings, and now you're seeing it with provisioning also. And they have been guiding that all year. This idea here that we are preparing for the worst, hoping for the best. And the way that this year at least is progressing is the worst has not materialized for the consumer, though you are starting to see cracks in the consumer. But to the point that Lisa's been making all morning, these banks that we're talking about, JPMorgan, Wells Fargo, Bank of America, they have been avoiding the riskiest consumers. So they are not feeling the pains of the worst of the U.S. economy.
Lisa, this line from Jamie Dimon at JPMorgan, now might be the most dangerous time the world has seen in decades. Now might be the most dangerous time, Lisa, the world has seen in decades.
We've heard the same thing from Paul Tudor Jones. We have a number of commentaries from people who are looking at the possible conflagration in the Middle East and seeing the potential for a lot of risk. The here and now, though, doesn't look that bad. And so, their prognostications about the potential outcomes of geopolitics are going to weigh less on their stock than on the here and now of still solid consumers and the fact that they're able to charge off less. I will just make this note. PNC did come out, and their third quarter revenue came in slightly below the expectation. So just to give you a sense, yes, provisions for credit losses came in below, but the revenue missed. Sort of the tale of two banks continues.
Let's turn to Jared Cassidy of RBC. Jared, you've been going through these numbers. What jumps out for you?
I think what jumps out, John, is what we were just talking about a minute ago, which is the credit side. As you guys have just identified, the provisions for loan losses are coming in much better than expected. Generally, it looks like, as you identified with Wells, the revenues came in better than expected. So really, the stocks are showing in pre-market trading by trading up that so far, the very quick read of the numbers, they're generally better than expected.
Gerard, the fact that JPMorgan shares are lower really edifies the point you were making. They have a much higher bar to clear given their performance year to date and a much lower bar for all the other banks to clear. Is that basically the read-through that any kind of beat for the likes of Wells Fargo, yes, it can lead to a 3% pop. JPMorgan, basically, it's been baked in that they are always going to have an upside surprise.
Lisa, you said it well. JPMorgan has had a great year relative to the other banks in performance. It's the risk-off trade. When we go around and talk to institutional investors around the country, as well as Canada and Europe, everybody is generally, not everyone's, a vast majority of investors are underweight banks except they own JPMorgan. So it's an over-owned name. And as you just described, it's showing that way today because they've done so well, but the others, the bar is much lower.
Elisa's making trading bank stocks sound easy, Gerard. Jared Cassidy of RBC Capital Markets on the latest. Got to turn back to that communication, that language being used by the JPMorgan chief executive, Jamie Dimon. Maybe the most dangerous time the world has seen in decades. Sonali, Ukraine-Israel may have far-reaching impacts on markets.
Absolutely. And if you're JPMorgan, where you're operating in most countries across the globe, you're certainly thinking about the risks that you can't control. Now, remember, let's talk about it from the trading perspective, from the volatility in currencies and commodities. These banks make money, and JPMorgan wants to be the intermediary for that. We've been talking about this, too, that wonky value at risk. This idea is these banks have to put up more capital here to intermediate markets. At what point does that start to become conflicted and this risk of markets seizing under the pressure of these geopolitical concerns? Right now, though, they are making money. Listen, one more thing about the consumer here. JPMorgan, average loans are up 17%. So it's not like that's better than they were last quarter. So they're still lending into what they think is a very terrifying, let's say it, environment, both for the U.S. and global economies.
Well framed. Seriously, JPMorgan right now, by the way, down by about 1% in the pre-market. Wells Fargo higher by 2.4%. Citi still to come. AMH, that language from the JPMorgan chief executive might be the most dangerous time the world has seen in decades.
No, the first time he's speaking about Israel, they have about 200 people in their offices there in Tel Aviv, and he talked about that all his employees are safe. But it is a dangerous time. I mean, in the last week, have we even talked about Putin's invasion of Ukraine?
Nope.
And what's happening in Ukraine, and also the concerns about what's going on in the Taiwan Strait?
Hardly been discussed. More reaction on the bank stocks coming up with Ken Leon of CFRA. JPMorgan a little softer in the pre-market. Wells Fargo rallying. Citi results still to come from New York. Good morning.
Unfortunately, even though the situation in the Middle East is very volatile, the market has gotten used to looking past events like these.
I think the market is just trying to find this equilibrium right now.
If I'm right that inflation gets down to 2%, then a 10-year Treasury at about 4.5% sounds about right.
I wouldn't be surprised if the 10-year does cross 5%.
You're going to see some form of yield curve control brought in to stabilize the bond market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro, together with Anne-Marie Hordern. What a mental 24 hours in this bond market. Yields down, then aggressively higher. Down again this morning by about 8 basis points on a 10-year to 462. Under surveillance this morning, bank earnings in full swing. JPMorgan beating on revenue. Wells Fargo gaining as third quarter revenue beats estimates as well. Earnings from Citi expected in about an hour from now. Goldman, B of A, Morgan Stanley all next week. And Bramo in the last couple of minutes, a new outlook for JPMorgan.
And basically we're looking right now at the potential for some sort of gain here in terms of how much they saw full year net interest income of about $88.5 billion. That is above the previous of $87 billion. So this definitely is a beat, and you can see them claw back some of the losses from earlier.
Given the monster moves we had in this bond market, let's talk about the commentary coming from the C-suite at JPMorgan on this. Jamie Dimon says the following, Bramo: the risk that interest rates rise further from here. Still don't know the long-term effects of QT.
This is the truth, and they don't understand this, and it speaks to what Jamie Dimon was saying when he said, well, we could see 7% interest rates. So the question is, how are different banks dealing with it? Are they hedging? Are they changing the mix of their assets? Are they buying a few treasuries? Is this the reason why we might not be getting the demand at some of the treasury auctions? Because guess what? Banks aren't the big buyers if they don't have to be in the same kind of way and are looking for new types of reserves.
And the price-insensitive buyer, the central banks, have stepped back. I keep going to what Daleep Singh had to say over at PGIM. We've lost that predictable source of demand in this bond market that dominated things for the last decade. Is there any surprise we're seeing these soft auctions at the long end time and time again?
But this then speaks to the uncertainty of banks and the fact that maybe they might be that much more price sensitive. They might be saying, look, you need to compensate us big time because not only do you need to offset us for the risk of volatility, you need to offset the risk of the treasuries that we currently have on our portfolio that might be totally underpricing the risk of inflation, as well as fiscal premium being baked in.
Fiscal premium. Are they talking about that down in D.C.?
No, they're not. They're talking about trying to get a Speaker of the House. Nothing can really get done at the moment. Steve Scalise, everyone thought potentially can get to 217. He can't. It still remains very unclear who in the Republican Party can actually get to 217.
JPMorgan, their stock totally unchanged, waiting for the results from Citi. Shanali's going to join us in just a moment. The latest on our top story over the last week, Israel calling for an evacuation of the roughly 1 million civilians in Gaza City, indicating a ground invasion could be on the horizon. Secretary of State Antony Blinken meeting with the president of the Palestinian Authority in order to ease tensions in the region. Next, Blinken heading to Jordan and Qatar. And today, Defense Secretary Lloyd Austin is expected to meet with Israeli Prime Minister Benjamin Netanyahu. Who isn't Secretary Blinken meeting with at the moment?
Well, he's doing a regional tour. Bahrain, Saudi Arabia, the UAE, Egypt. Missing on this list, and you need to pay attention to, is Turkey.
Especially because Erdogan has come out very much in support of the Palestinians and against Israel in this particular situation.
And criticized the U.S. for sending in Gerald R. Ford and said that would cause, quote, massacres in what is going on in Gaza. There's a lot of tension right now between Ankara and Washington.
You mentioned this already in the last couple of moments. Let's talk about it. The search for the next Speaker of the House taking a step backwards, moving in the wrong direction. Majority Leader Steve Scalise dropping his short-lived campaign after failing to secure enough votes among fellow Republicans. A clear favourite has yet to emerge, despite some support remaining for Congressman Jim Jordan of Ohio. Can Republicans get this together anytime soon?
Doesn't look like it. I mean, what you heard from Steve Scalise yesterday was it wasn't going to happen today. It's not going to happen tomorrow. I'm withdrawing my name. There is talk of potentially it just needs to be someone who is completely out of the leadership, who has been out of the leadership this year. The problem is they can only lose, whoever this individual is, if Democrats stay together, they can only lose 4 votes. At some point, you might see a moderate Republican come out and say, listen, I'll have a bipartisan ruling coalition with the Democrats. But we're not there yet.
All I can say is that things have gotten so dysfunctional that not only do we have members that are contesting the election and that are potentially going up against each other, we don't even have a name. We're talking about potentially somebody who hasn't even been named yet coming in that might not even be in leadership. There's also discussion about Patrick McHenry being given a 65 or 45 or 60-day temporary position as speaker. He's saying, I don't want this. This is ridiculous. So we're dealing with a situation that is fraught and is opening the pathway to something like you're talking about.
But a Patrick McHenry could actually be very smart for the Republican Party. November 17th, we're potentially going to have another government shutdown. That is how Speaker McCarthy lost his job. Maybe they just throw it on McHenry. You're going to have to do a stopgap. You're going to have to keep the government open. Just let him deal with this, and then by next year, we can elect another speaker.
I'm guessing that's another reason why he doesn't want this job at all. We'll talk about this a little bit later. Greg Valliere, later on this hour of AGF Investments. Let's talk about the banks. JPMorgan results out in the last 15 minutes or so. The stock not doing much. A new outlook for the big bank on Wall Street. Full year net income interest of about $89 billion. They had seen previously $87 billion. Net interest income, Shanali, better at JPMorgan.
Well, not only is it better, it's because you're seeing them really lend, and the consumer is taking on more loans, especially excluding credit card loans. You're seeing consumer loans start to rise on average at JPMorgan. We were talking about this. How much demand really is there for loans in this interest rate environment? How much propensity is there from the banks to lend to the U.S. consumer, given those concerns about the economy? Jamie Dimon, as you've been saying, strikes a very dire tone about the global geopolitical tensions that we're seeing, but the numbers are showing you something more rosy in terms of what they're able to do by servicing U.S. consumers.
Square this with their sort of dire calls that if they're overregulated, the profitability goes down the toilet. There is a question. JPMorgan did say that the quarter included $113 million of net reserve build, kind of speaking to that regulatory story that Anne-Marie has picked up on. How much is that bigger, less? Put that into perspective about what that actually does to a bottom line that looks pretty good.
I have to be honest with you. I'm dreading the conference call because you're not going to get a whole lot of answers here in terms of the direct financial impact that will happen over time with the rules that are coming forward, because the banks are still fighting these rules. They are taking to Washington and storming the Hill and saying, we don't need these. We are lending to the economy. Seriously, though, I mean, it's all you really hear about, because the uncertainty behind those new rules could be very damaging. They could wipe off a very significant amount from the bottom line, as well as restrict the capacity. Now, you're talking about the Treasury market. That is very relevant to these new rules, because what they're saying is intermediary capacity is further threatened by these new rules. And what you're seeing also is Jamie Dimon really clamp down on the we don't know what QT, quantitative tightening, looks like yet. So why constrain further?
Shanali, stay close. We'll talk more about this. Joining us now, I'm pleased to say, is Ken Leon, Director of Equity Research at CFRA. Ken, you've gone through the numbers from JPMorgan, from Wells Fargo. What stands out for you, sir?
We got through the quarter. So year over year, we did see gains, but compared to the second quarter, both banks held their own. So I think operationally, this was a good quarter, both on the consumer and commercial lending, barring real estate, is still very good with double-digit growth for JPMorgan Chase. It really sets up the bigger story here. And we talked about capital risk. We talked about rising rates. But the market is thinking if we have a soft landing in the second half of next year, financials tend to do better 9 months before, and JPMorgan is one of the top 3 of the weightings for the sector. So that, to me, is the cornerstone for the bank story. Then we have to go through what does rates do to the consumer, plus what eventually happens as it relates to, credit risk, which seems to be everything is under control. As we see with reserves and actually some reserve releases in home lending for JPMorgan.
Again, we're getting the results from the big banks, and this has been a pretty strong result. Fewer credit loan loss reserves put aside. But then PNC is cutting its headcount by about 4%, and we are seeing a more mixed picture, hitting a lower than expected revenue target. How much is this really painting the picture for you? That basically big banks are not the banking complex when it comes to the health of the U.S. consumer, the health of corporate America, and they're a reflection of that.
Well, I still think they're there. And then as you go from the global U.S. banks to the super regionals, you begin to see the really stronger weighting to lending and also net interest income, just because they're not diversified. And it does put added pressure on them. And I would think the first 5 questions on the regional bank calls are really going to be about regulation and higher capital risk for those banks with more than $100 billion of total assets. It's a new regime that's coming in for these banks as well. And as you get to the very small banks, then you begin to see some exposures to deposit risk or narrowing of spreads. This is, basic bank fundamentals. The other regime here, which is a conversation for another day, is private credit. And what we're seeing is, I want to see how many times on the large banks we hear the word, we want to go balance sheet light. We want to find partners to offload some of our credit where it might be too expensive to keep it for credit regulation.
So just quickly, does that mean that from your perspective, it makes sense to value banks like utilities, especially the big banks that are showing a great deal of safety and precaution?
Banks are directionally, unfortunately, moving to being more regulated and being more utility-like. And what keeps me up at night is when you look at the securities, you have to have a competitive dividend yield, dividend growth. All that is return of capital. At the same time, across all the regulatory agencies from Fed, FDIC, they're looking for higher capital reserves. So it's not the best scenario ahead. The only way that you can outrun that is having a soft landing of the U.S. economy.
Hey, Ken, stick with us. Ken Leon there of CFRA. We'll be breaking down Citi in about 20 minutes from now. JPMorgan totally unchanged in the pre-market. Wells Fargo a little bit higher here, Bramo. Not big moves, up by 1.8%. What you heard from Ken there is just why it's so difficult right now for bank stock bears to change their mind on these names.
Exactly. They can come out with better than expected performance, and it still isn't going to change the scenario that they cannot necessarily buy back their shares in the same kind of way or give dividend payments the way that their shares might imply, because they are increasingly regulated and are going to have increasingly conservative profiles that limit the upside gains traditional for a big bank. Numbers from JPMorgan and Wells Fargo behind us. Citi still just ahead about 20 minutes from now. If you are just joining, welcome to the programme. You probably want to know where the bond market is after the sell-off we saw yesterday. Yields are lower by, guess what? Double digits, 10 basis points lower on a 10-year to 460. If you're looking at the equity market on the S&P 500, negative here by 0.1%. The big moves, Lisa, they continue. It's why I keep framing the question. You want bond market stability. What do you really mean? Do you want yields lower, or do you just want smaller moves day to day? How about both? How about yields lower and smaller moves day to day? This is a market that grew up under a regime that was both, that was incredibly low rates, that were incredibly stable, and that were controlled by the Fed, and this idea that we're going to get low inflation forever. There has been a regime shift. Nothing has broken yet. Some people might argue that on the peripheries, whether it's the regional banking crisis or whatever, things are breaking. And is that giving people confidence or actually more fear that the volatility is going to perpetuate and become that much more extreme over the near term? To your point, something did break this year. The bank stocks broke in response to what we saw, Shanali, in the Treasury market. Do these moves make it worse?
Yes. I mean, the thing about it is that you're seeing deposits starting to stabilize, so maybe we won't see the same sort of drastic pressures. There are different ideas out there in the market on whether we'll see more failures or not. The worst is probably over, according to most market participants, but that doesn't change the story about the pressures you're seeing. We're talking about loan growth. Yes, great. All well and fine. Expenses are also growing. The flip side of that is, you have JPMorgan and the headcount is up. And so they're hiring. They're willing to spend more on wages. And so, the relative stability is allowing them to invest. But investors don't have a story to latch on to yet until that story starts to turn around.
Stock just a little bit unchanged on JPMorgan. Just a little bit firmer by, let's call it 0.2% on the S&P 500. That's the bank stock story. Citi coming up in about 20 minutes' time. We'll talk about politics as well, abroad and at home, with Greg Valliere of AGF Investments on the search for a new Speaker of the House. The comedy in Washington, the dysfunction.
Is this comedy?
Continues. Not very funny, is it?
It's horrible.
At the end of the day. From New York City this morning, good morning.
We pray for resolving this conflict as quickly as possible. The longer it goes, the more the risk of spillovers grow. And where we are as a world, we simply cannot afford more uncertainty, more hate.
That was the IMF Managing Director catching up with TK. Bloomberg's Tom Keene a little bit earlier on today. We'll catch up with TK ourselves in about 15 minutes' time. Then 30 minutes after that, we should get some numbers from Citi in the next hour too. Looking ahead to all of that, your equity market on the S&P 500, negative here by 0.1% on the S&P. Just had a message from a Bloomberg subscriber about the numbers we got from JPMorgan. Let's start with the fear first. Earnings season, alarm bells, consumers falling cash buffers, inflation, monetary policy risk, the consequences of war. We're leading in that. We're talking about it. Then ultimately, Bramo, the bank raised this year net interest income forecasts, provision for credit losses, net charge-offs lower than expected. Which one do you want to focus on? Which piece of this?
Basically, if you're an investor, you focus on the fact that they're making money and they're making more than they expected to. If you're someone who's a policymaker who wants to hook into what the broader messages are, maybe you'll hook into the other. But for our reasons, I think that we've got to look at the numbers because the numbers speak for themselves. The uncertainty is clear. We all know about the uncertainty, or we know that there are a great deal of unknowns. The certainty is they're making bank. And I think that is what we could take away.
And Tom talks about this all the time. They're almost hiding how much money they are making by leading with these dreadful headlines.
It's true.
Elsewhere. Just see it every single quarter. Not just JPMorgan, but, across the street, time and time again. Let's turn to Greg Valliere, the Chief US Policy Strategist at AGF Investments. Greg joins us now. Greg, wonderful to catch up with you. We had this phrase that we borrowed from a famous comedian in the United States in the last hour. Aren't you embarrassed? Is Washington embarrassed by the dysfunction that's playing out currently, given what's happening in the world?
Well, we should be. This city should be embarrassed. It's a clown show. It's a circus. And the serious part of the story, John, is that there are three big things that have to get done. One is, of course, a budget. And I think that November 17th deadline will slip. Maybe they'll do another extension probably into next year. Number two, we really need more aid for Ukraine. They're starting to run low. And now a third story, of course, and that's aid to Israel, which is mandatory. The irony here is that a vast majority in both houses, in both parties, want to do all three, but they can't get it done.
Greg, who can get to 217 within the Republican caucus at this point?
You got me. I mean, I thought that Scalise would be likely. Jim Jordan isn't exactly Mr. Personality. I'm not sure he's going to get there. So I am beginning to think they go for someone less well known. There's a House member from Minnesota, someone from Oklahoma. They may go for a fresh face who's not as badly damaged as some of these others.
Are Democrats just as much to blame for this paralysis we're seeing in the House of Representatives?
Well, a little. I mean, everybody's blamed. A pox on both of their houses. But I would say that Hakeem Jeffries and others are valid in saying, why should we bail them out? They want to impeach the president. They've done a lot of things in the last year that have been inexcusable, according to the Democrats. So I think they're not in any great rush to help them out.
Greg, for a long time, this stuff hasn't mattered. Does it matter now?
It does. I mean, we need these loan packages. We need to get a budget. People worry about government benefits, their salaries, things like that. And there's one other factor, John, that I think could come into the narrative once again. And that's the credit rating agencies like Fitch and S&P. I wouldn't be surprised if we see another credit rating downgrade on the U.S., and that's not a good story.
Every investor who's come on has said that there is absolutely no incentive to grapple with the real issues that are going to cause serious problems for the U.S. economy and for the U.S. deficit, Medicare, Medicaid, defense spending, and some of the other entitlements, Social Security. How much do you see a greater willingness later this year or next year if interest payments start to significantly be the main expense of this country?
Well, you're speaking logically, and logic doesn't always apply, Lisa. And I don't know that will make a big difference. The problem is, I go around the country, I talk to investors and ordinary people, and they all say, we have to reduce the deficit. And then I give them a list of options, and to everyone they say, no, these are not doable. These are not politically sellable to the voters. So we could have a national consensus that we need to do something on net borrowing costs, but there will not be a consensus on the specific prescriptions.
Nobody wants to take the poison to come along with the medicine. There's a question here, though, Greg, especially as we face off with a number of conflicts around the world where we have the U.S. calling for more money and more resources to be deployed, whether it's Israel, whether it's Ukraine, whether that's going to mean more borrowing and an even bigger deficit. Do you see that in the pipeline, that basically not only is there no incentive to cut, but there is incentive to spend more, and the result will simply be felt maybe at some of these bond auctions we've been talking about?
Two enormous wild cards that I think will determine the answer to your question. The first is, could we see movement by Hezbollah in the north? That would be horrible to open up a second front. And secondly, Iran. I think once Hamas is dealt with, and they will be dealt with, I think the Iranians will be targeted for at least some kind of increased sanctions because of their support for both Hamas and Hezbollah. So those factors, to me, would make me think that a lot more spending on defense is going to have to occur.
We saw yesterday the administration come out, along with Qatari officials, and say that Iran at this moment cannot access that $6 billion that was unfrozen from the South Korean banks for the prisoner swap. Is this administration going to come under increased criticism for their strategy in Iran specifically?
Well, the Iranians are furious. The New York Times broke the story early this morning. And I think this is going to be a big controversy, but they're not going to get that money. I think that is inconceivable, considering all the political problems Joe Biden has. The last thing he needs is to give the Iranians $6 billion.
Just a week and a half ago, Jake Sullivan, Greg, said the Middle East was the quietest it's been in decades. Today, we have Jamie Dimon, a CEO of JPMorgan, coming out and saying the world is the most dangerous we've seen in decades. Is this administration going to face the consequences of what is going on in the foreign policy sphere come November of next year?
They may. I mean, there are so many things, my Lord. The fact that we're averaging 8,000 illegal immigrants a day coming into the U.S. We have big urban crime. Average voters don't think inflation has been subdued. So, yeah, I mean, this could be still another huge albatross for Joe Biden. He's in a difficult spot. I think that Blinken is good. I think Sullivan's good. I think they may calm this thing down by the end of the year. But I think we got several really rocky weeks ahead.
Greg, it doesn't look great. It really doesn't. Greg Valliere of AGF Investments. Greg, thank you, sir. We're looking ahead to some key events. We need to talk about the privilege of acting recklessly with a budget deficit. For a long, long time, this government, this country has had that unique privilege given they issue the Treasury bond. And now looking at the moves we've seen over the last few weeks, I'm not saying it's completely lost, Bramo. I'm just saying you can see clearly there's a deterioration in appetite for treasuries in this market, particularly at the long end.
And when you talk about the privilege of acting recklessly, when suddenly interest payments, interest expense needs to be considered as a massive line item in the U.S. budget, suddenly you have to care a little bit more. And if you don't, then potentially you could get into this spiral where yields go higher and then interest expense only increases that much more.
The Congressional Budget Office, you need to see this chart. 28 years, it'll be the top issue. Interest payments will be the top line item the U.S. is paying for. And it's both parties to blame. You know, Republicans love to bash Democrats. They love to spend. Republicans love to spend, too. They also love tax cuts. Remember, it was the Trump administration that added nearly $8 trillion, which Nikki Haley, by the way, loves to bring up, to the deficit.
Everyone's super responsible until they get into the White House, get power, get majorities, and then all of a sudden it goes away.
I will say that it is everyone's responsibility, and I'm just going to be at a soapbox in for 1 second. I know you're probably rolling your eyes internally. But
Lisa, that's the show.
But nobody wants you rolling your eyes internally. But nobody wants to take the pain. Nobody wants to see their payments lowered. I understand this. I am a human being. Nobody wants to see the resources that you're used to getting pulled back. So then if you don't have a population that's going to vote for that, where is the incentive going to come from an individual leader?
The Treasury market will have to force the issue.
Exactly.
And that's not going to be pretty either. From New York City this morning, equities down 0.1% on the S&P 500. Yields in 8 or 9 basis points, 460 on a 10-year. The commodity market, crude picking up by 3.7%, $85, let's call it $86 a barrel. Equities on the S&P 500 pulling back just a touch. On the S&P, we're down by 0.01%, recovering very slowly this morning. Off the lows and now unchanged. On the Nasdaq, we're negative by 0.3%. It has been quite a week in the bond market. Yields all over the place. Yesterday, double-digit moves higher on a 30-year yield, higher at one point by almost 20 basis points. Two-part story. One part was the CPI report, small upside surprise, got yields moving, got things going, then bang, 30-year issue, auction, came later on in the afternoon, and Lisa, it did not go well.
I just want to say, every time I used to bring up auctions in the look ahead to the day ahead, Tom would roll his eyes and he would say, who cares about auctions? Is this really going to matter? And I could just say every day this week, the auctions have disappointed, have tailed. That's the jargon that people talk about, which is incredibly rare. And it moved the entire market. This was actually the trigger for yields to go much higher, much more than CPI and PPI. And so when people lump them together, I'm sorry. I have to say, really, because if you looked at the action after what we got, not so much.
I was always happy doing issuance, just so you know.
You're just putting that on the record.
Used to have a show, which Shonali will be anchoring later, Bloomberg Real Yield, which has an auction blog.
Yeah.
I agree, it's very, very important.
And right now, more so than ever, because it's testing demand. And guess what it's telling us? People don't want to buy right now.
They don't want to buy. Is that buying going to come back if yields go back to 5%, 5.1%, 5.2, 5.50? Jamie Dimon 6, 7,
8.
Who knows?
I mean, this is sort of the question, right? And is it going to go up in a straight line? And if not, and you've been asking a really important question, is it the level that's more important, or is it the way that it is moving, given the fact that Michael Schell was talking about yield curve control to control potential dysfunction in markets?
When equity market bulls say stability, what they mean is lower yields. I think people in the Treasury market mean smaller moves. That would be my distinction.
I think that that's true. However, you're seeing so many more analysts coming out and saying, as long as you don't breach 5%, we're good. We can make it happen.
Are we good right now? 462 on a 10-year. Let's turn to foreign exchange. Dollar stronger against everything in G10 yesterday off the back of that big move. Yields higher this morning. The euro just slightly negative, 105.22. We're negative by 0.06% on the day, Lisa. Had a look at 104 in the last couple of weeks, a look at 106, we're back to 105.
It seems to be where we're kind of sticking at the moment. We are watching the potential analyst calls. Citi earnings due out in about a half an hour. We did get JPMorgan and Wells Fargo, both beating expectations, increasing net interest income expectations. I am interested in the calls. 8:30 a.m. we get JPMorgan, 10 a.m. Citigroup, and 11 a.m. 10 a.m. is Wells Fargo, and 11 a.m. is Citigroup. 10 a.m. This might move the market, maybe not. Facebook Live, another one with UAW President Sean Fain. What more can he say after a serious escalation that we saw yesterday, with the potential for just to say, we're done negotiating? So what more can he announce?
What's on the table? 23%?
23%.
And what are they after now? 30-something?
It's a good question. Is it about the 30%, or is it about some of the guarantees about employment? They've been asking for 30%, but they've also been asking for a whole host of other things.
Ford has already said we're at our limit. And this was a huge wild card to play going after this truck factory.
So they're at their limit for the total package, right? And they're basically saying to UAW, we can have a conversation about how to move things, but these are the parameters. This is the total package.
So now, are there going to be further strikes announced, further walkouts, or is this the end of the road? And at 10 a.m., we do get that University of Michigan sentiment survey, which, John, is not going to be called on, has not been called on, will not be called on. And yet this is what people are going to be looking at for not only just sentiment, but the look ahead for inflation expectations, and you can mock it, et cetera. Yet this has moved the market, too, because we are so in the dark with what potentially is shaking things up right now.
We can talk to a man who has taken that call over the years many, many times. Tom Keene at the IMF meetings, the annual meetings in Marrakesh, Morocco. TK, wonderful to catch up with you, sir. I know you have a brilliant panel coming up a little bit later on this morning. We'll be taking some of that on Bloomberg TV and Radio. TK, what have you got to look forward to?
What we're going to look forward to here is a debate about economic growth. But I'll be very honest, John, as we've seen over the years at Davos, at IMF and other meetings, when the events change, these meetings change. And there's a tangible somberness here with everyone glued, as we are at Bloomberg, to what's going on in the Eastern Mediterranean. It's absolutely front and center, and the managing director this morning was quite emotional about it after a long 24 hours.
Tom, there's been a big question about just how unilateral, just how much the IMF brings the world together versus really trying to grapple with a splintering in the world order. How much unity do you feel among the people that you're talking to in terms of resolve, in terms of goals?
Lisa, this is a really, really important question in that you don't hear Davos speak. It's sharply different from the meetings of the World Economic Forum. And the managing director reaffirmed today their economic mandate, which is what they do. They don't try to traipse upon what the World Bank does. I would say, John, to your point in the bond market, and it'll be no surprise to you, I was having a beverage of my choice last evening at La Momunia Hotel doing my Jimmy Stewart imitation. And John, I saw Japanese yen move with that bond market. John, that's the great unspoken here, is the bond market. Everyone's watching about it. Nobody's talking about it.
I love that you're in the bar pretending to work, TK. Never change.
He's not going to respond to that.
We'll see. I mean, there's still time to go here as we stagger back to New York. But, I must admit, John, it's just great to see you and Lisa and the other person doing a tryout in my chair. I just think I can't get home fast enough.
Oh, Tom, we miss you. Tom in the desert.
Tom Keene at the IMF meetings in Marrakesh, Morocco. TK, your seat will be here when you get back. Looking forward to catching up as always, and looking forward to this panel, which includes Geeta Gopinath of the IMF and Christine Lagarde of the ECB. Timely conversation with Lagarde here, Bramo, coming up later.
Especially given the fact that you have seen a weaker euro and the potential for natural gas prices to really go up, not to mention the reliance on Qatar for some of their natural gas at this point.
9 Eastern time, a few hours away for that conversation with Tom Keene in the desert. TK in the desert. There's one for you. Yeah. Mark Lucchini joins us now, Chief Investment Strategist at Janney Montgomery Scott. Mark, wonderful to catch up with you, sir. Let's just talk about this monster move in the bond market yesterday. The 30-year, with a move at one point of more than 20 basis points. Just absolutely ridiculous stuff. Mark, what do you make of these moves we've seen in the Treasury market?
Well, good morning. It's certainly volatile and breeding even more volatility by the way the uncertainty in terms of the directionality of these moves in the market. I mean, obviously, we've had a bit of a retracement in longer term bonds here since the last couple of weeks after having blown out about 50 basis points since the FOMC meeting on the 10-year Treasury yield. And now it's coming back in a little bit, obviously whipsawing investors who were worried we were going to test a 5 handle on the 10-year and even higher in the 30-year, and conversely, it's come back in just as hurriedly as it went back out. So, I mean, obviously, it is a function of a number of factors, the confluence of which probably include the lack of buying interest and not knowing where these yields are ultimately going to settle. Issuance continues to play a role, and there is a lot of judgment being applied, subjective judgment, on how much of the effect of this is occurring because of the term premium and the uncertainty around not only inflation, but to what degree growth and perhaps an improvement in productivity on a go-forward basis might keep yields more elevated historically than what we've seen over the last 10 or 15 years. And a consequence of that, of course, is leading to these kind of movements that you've talked about, which is obviously keeping investors on their heels.
And earlier this year, we did see this percolate out into a regional banking crisis. Certainly that has remained, at least in the share prices. And yet what we've seen this morning from JPMorgan and from Wells Fargo are upgrades to their net interest income, fewer charge-offs than expected, a pretty robust report at a time when the volatility is creating more activity, at least when it comes to trading revenues in certain segments. Mark, are banks looking better because of the higher yields at this point or worse?
Well, certainly the money centers, at least so far from, as you mentioned, what we've seen from JPMorgan and even Wells Fargo, which is a little bit different in terms of its overall portfolio composition. But the money centers are in better position to weather this inclement volatility in the fixed income market. And certainly JPMorgan benefited from the acquisition of First Republic's assets and the deposits associated with it. So it's obviously very encouraging to see the results early on in terms of how that's positively impacted their net interest margins. questions, and I'm going to be curious, as you had mentioned, at 10 o'clock in terms of what management is talking about with regard to consumer. There was some creep in delinquencies we've seen in auto loans, particularly subprime, credit cards. We want to see to what degree that continues to be a pattern, or is it, again, something that is occurring so glacially that it's not going to worry us and others with regard to the state of the consumer. But, it's more the small and mid-sized banks that will report here in the coming weeks that'll be important, because obviously with yields where they are at or even above where they were back in March when we had the initial bank turmoil with SVB and others failing, that continues to be a problem for the balance sheets of these small and mid-sized banking enterprises. So obviously they tapped the Fed's window back then, and to what degree, again, they're underwater, and it continues to influence their profitability, their net interest margins, because they've had to raise interest rates to retain deposits, is going to be a tell on whether we see any kind of near-term recovery, particularly, once again, the banks outside of the major money centers.
How much, Mark, are you looking at any commentary on the consumer to really influence whether you're going to buy consumer discretionary or where we are in the cycle?
Very much so. We like to look at what the management, the CFOs, the CEOs of these banks are talking about. I mean, after all, these money centers are in every facet of the economy. They're the bloodline to the economy in terms of not just credit extension, but obviously what they can see through by way of the behavior in savings deposits, to what degree this abundance of excess savings is being drawn down to help to support spending, obviously, which propels economic activity here in the United States, to what degree they're seeing some hesitation on the part of borrowing, to what degree tightening lending standards, which we know have already been underway now for almost a year, continue to influence their consumers' ability to go and borrow for durable goods such as automobiles, obviously housing's in the doldrums, particularly as it relates to existing home sales, and last but not least, obviously, delinquency rates, and to what degree they're having to provision for.
Hey, Mark, wonderful to get your perspective, sir. Thanks for joining us. Mark Lashini there of Janney Montgomery Scott. Let's talk about that range on a 30-year yesterday. Think about this. More than 20 basis points. At the low, 466.70. At the high, 488.37. Bramo, you and I have said the same thing time again over the last year. At times, it's like the 30-year has become a penny stock in the Treasury market. It's been absolutely remarkable to see.
We haven't seen companies really have to bank the paper losses, though. And this remains one of the key questions. When you actually have to bank losses because the moves stick for long enough, then what happens? Do we actually have to start to understand the ramifications of, to Tom's longstanding point, the price move, not just the yield move?
The TK looked happy over in Marrakesh, didn't he? Just comfortable. Been to the bar talking about dollar yen.
Think he
can picture that.
There on a camel.
What, in the desert?
In the desert.
Vitamin D, getting some sun.
Getting some sun. Yeah. This is for health reasons.
Yeah, oh my goodness.
Sure.
You think he's going to be outside?
You think Tom looks after himself on tour? I don't think so. I don't think so. If you just joined us, welcome to the programme. On the S&P 500 right now, totally unchanged on the S&P. We're negative by something like 0.03%. Yields are lower by something like 8 basis points on a 10-year, 461.65. We've got to move lower across the curve. The 2-year out to the 30-year. The 10-year is lower by 8 basis points. The 30-year is as well. We could talk about the price losses, Lisa. What are we talking about? 50 cents on the dollar at the long end for some of these bonds that were issued 3 years ago at the long end?
And if you just hold it and you do use the Fed's facility, which is what a lot of banks are doing, you can park it there and just get the face value back, and you don't have to record them in the same kind of way. So offset some of that risk. However, if you have investment firms, and this is something that we were talking about with Priya Misra, who are actually recording those kinds of paper losses, all of a sudden, investors see their safe assets, their assets that are the ballast to their portfolios, providing the biggest losses they've seen ever. What happens if people start withdrawing money?
They're not so safe anymore, are they?
But what happens if you get outflows?
I'm with you. Then you've got big problems.
You got big problems.
You might see selling elsewhere as well. Shanali, lucky to have you with us this morning. Those unrealised losses, how insulated are these banks from them, given the policy moves we saw several months ago?
Pretty insulated, but if you see what's happening here, a lot of this move is happening in the private bank. It's the wealthier individuals that are also borrowing more, and they're more insulated to the economy than others. Other parts of the bank tell different stories.
Shanali, Citigroup, about 17 minutes away. You're going to stick with us to break down those numbers in just a moment. Coming up next, Congressman Mike Lawler, the Republican from New York, is going to be joining us very shortly. From New York City this morning, good morning to you. Equities going absolutely nowhere. Bond markets all over the place. Nothing new about that. We're down 8 basis points on a 10-year, 462.
I just share with my colleagues that I'm withdrawing my name as a candidate for the Speaker designee. And that was very clear. We have to have everybody put their agendas on the side and focus on what this country needs. This country is counting on us to come back together. This House of Representatives needs a Speaker, and we need to open up the House again.
And we don't have one, and we're still searching. That was Congressman Steve Scalise, the House Majority Leader. Joining us now, I'm pleased to say, is Congressman Mike Lord, a Republican from New York. Congressman, great to have you with us on the programme, sir. I'm sure this is immensely frustrating for you. A time for America to project power, and at the moment, Washington, D.C. seems to be projecting dysfunction. How frustrated are you, sir?
Pretty frustrated, but you know, right behind the camera lens is the Capitol. And I was just looking at it before the commercial break, and the sun is shining down on it. And we've been through tough times in this country, and you know, we will get through it. We will be meeting this morning to reconvene and begin the process anew to elect a speaker. We have to come together as a conference, 217. To elect a Republican speaker in a Republican majority. The American people elected us to serve as a check and balance on the Biden administration, from spending to the border to international policy. There's a lot of work to do. And obviously, one of the first orders of business is to support our closest ally in the Middle East, the state of Israel, to ensure that they have the resources financially, militarily, to do what they need to do to defeat Hamas.
What can you do, Congressman, in the next 24 hours to make sure that happens? There's a big issue right now for your party. Not only should this country be projecting power and solidarity with Israel, your party also needs to demonstrate to this country that you can govern. Why is your party failing to do that?
Well, look, what happened last week with the removal of Speaker Kevin McCarthy never should have happened. 8 Republicans teamed up with 208 Democrats, and I think people need to remember that. Both parties threw us into chaos here for no reason. And it was totally unnecessary, unwarranted, and unjustified. And so now we're forced to pick a new speaker. This is not like just electing a class president here. You actually need somebody who can do the job and do it well. There's a lot that is entailed in it. And, you know, I think we're going to get back in the room today, hash it out even further, and hopefully elect a speaker. Ultimately, again, when we get back to the work of the American people, there is a lot of critical work to be done, from the appropriations process to securing our border to increasing aid to Israel. We also have to deal with aid to Ukraine. These are critical issues, and I'm focused on that work, especially as a member of the Foreign Affairs Committee and the Financial Services Committee.
It's not just about who can do the job of speaker. It's about who can get 217 votes. A lot of your colleagues say they don't see anyone that can actually get to 217. Do you know an individual that can get to that number?
Look, we're going to come back in the room. We'll see who puts their name forward. I believe our strongest speaker is Kevin McCarthy. I said it this week. I said it last week. I said it the week before. I said it in January 15 times. We're going to have to hash it out. And obviously, there's some anger, some frustration, some hardened feelings in the room. But, you know, if we need to bring a Festivus poll in and let everybody air their grievances, so be it. But we have to get back to work.
Your district voted for President Joe Biden. Is it time for members like you to reach across the aisle and find a centrist speaker with the Democrats?
Well, respectfully, again, the Democrats helped create this mess. Everybody should remember that. 208 Democrats voted to remove the speaker. And the American people elected a House Republican majority to govern. So any deal with the Democrats would be to elect a Republican speaker. We need to exhaust all options within the conference. But ultimately, as a nation, as a country, we need to get back to work. And frankly, in my conversations with many of my Democratic colleagues, they regret their vote to remove Kevin McCarthy because they see the chaos that they've helped create.
But then, Congressman, to build on Anne-Marie's point, are you getting close, especially with your Democratic colleagues, to move towards some sort of centrist candidate to put up and then to be able to elect any bipartisan measure?
Look, right now we are meeting again today. I think we owe it to the conference to continue the discussion, to see any other candidates that put their name forward, take a vote, see where it lands, and then take it from there. Obviously, we want to get back to work as expeditiously as possible and get back to governing. That is why we're here. That is the focus. The American people are not interested in inter-party squabbles. They're not interested in, the parlor game that often goes on in this place. There's real work that needs to get done, and that has been and will continue to be my focus.
A lot of people talk about the former President Trump as being the front runner and, frankly, the leader of the Republican Party. Who do you think is the leader of the Republican Party at a time when it desperately seems to need a leader?
Look, Kevin McCarthy was doing a phenomenal job as the highest-ranking Republican official in Washington. And I think it was the single stupidest political act that I've ever seen to remove Kevin McCarthy as Speaker. It undermined the majority. It torpedoed the work that we were doing. And, I said earlier this week that he is our best player on the field and should have remained as Speaker and, ideally would come back. But, obviously, right now, we need to elect a Speaker. That's the focus for me in Washington.
Congressman, this week you called on the Biden administration to start charter flights out of Israel. The State Department announced those flights yesterday. You have hundreds of constituents stuck in Israel. What are you hearing from them on the ground?
Well, there's a lot of frustration, a lot of angst, a lot of concern. People want to come home. Many of my constituents were in Israel for the holidays and, when the war broke out. And so obviously they want to get back to the United States. I've been in touch with the White House multiple times, the State Department multiple times to try and expedite this process to get these folks home. I had called for chartered aircraft as well as military aircrafts to try and expedite this process. We have nearly 600,000 American citizens in Israel, many of them dual citizens, but it's 600,000 Americans. And so, obviously anytime you're in a war zone, you want to protect the American people that are there. Obviously, over 20 American lives lost. We still have people missing, potentially hostages. We need to do everything we can to bring our Americans home.
Congressman, a lot of your constituents in the Jewish community, I'm sure, here at home are on edge. Hamas, which, as you know, designated a terrorist group by the United States, also by the EU and the UK, calling for a day of rage today across the Muslim world and mass protests against Israel. Congressman, are you worried about the safety of your constituents, and what are you doing to make sure they have the security they need?
Well, I'm always concerned. I have one of the largest Jewish communities in the country, in the 17th Congressional District of New York. Unfortunately, threats of violence against the Jewish people are not new. And so law enforcement in my communities across my district have always done a phenomenal job working with leaders in the Jewish community, working with municipal officials to really ramp up police presence at synagogues or Jewish institutions to ensure that we don't have acts of violence. Just a few years ago, we had an attack in my district in Muncie during Hanukkah, killing an individual, and we want to avoid any such incidents across this country. But certainly in areas like mine, where you have large Jewish populations. So law enforcement always does a great job. I know they will step up.
Congressman, thanks for being with us today. Hopefully we can catch up again soon, sir. Congressman Mike Lauder there, Republican, on the latest dysfunction in Washington. Coming up very shortly, Ken Leon of CFRA, Citi earnings just around the corner.
At the end of the day, financial stability is the unspoken mandate of the Federal Reserve.
There's still plenty of weights on the economy here, and certainly when I look at inflation, I still think it's coming down.
That last mile to get us back down to 2% on a sustained basis, that's tough, and that's why the Fed is probably going to remain restrictive.
The question really for the markets is how long they keep rates high for longer.
I think this market is underestimating, or your typical bond investor is underestimating the strength of the consumer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro, together with Anne-Marie Hordern. Let's get to the price action right now on the S&P 500, totally unchanged. Bank earnings all morning from JPMorgan, from Wells Fargo, and right now from Citi. Fixed sales and trading revenue, $3.56 billion. The estimate, $3.25. You want equity trading and sales revenue, $918 million. The estimate, $964. And investment banking revenue, $844 million. The estimate, $662.8 million. The stock is higher by 2.3%. Shonali Basak alongside us with this morning to break down some of these numbers. Tons of numbers there, Shonali. What's the story?
A few things. You have credit losses coming in line with expectations. So very clean read across the three biggest banks in America in terms of that big worry of credit, consumer credit turning sour. It's just turning sour enough to keep lending at a greater scale to the economy. And now for Jane Fraser, this moment is a pretty big deal. She just got through announcing the biggest restructuring of her senior staff in 20 years. And you're watching her really win here on trading, investment banking. These are areas of Citigroup that have faced dramatic changes in personnel. Remember, the investment bank is now being run by an interim head. And so for her to beat on that regard in investment banking in a weak market is showing you that her changes are starting to take some steam, even as she's just thick in the middle of it.
And we will get some themes as some of these come out. JPMorgan and Citigroup both beating on FIC and missing when it comes to equity revenues. People will wonder what that means in terms of gaming out the volatility that we have seen there. Citigroup's expenses, operating expense, came in lighter than expected, which speaks to the reorganization. What are we expecting to hear later on in the investor call about how she plans to rearrange exactly how the bank is orchestrated and where they want to be a little more aggressive and where they want to be a little less?
Listen, the process Citigroup is going now. The process is going such that they're going through every manager around the world and saying, do we need these jobs? And so that is a very, very painful exercise. And she herself has acknowledged that it's painful. But from the investor perspective, how painful could it be in terms of potential severance costs and other costs tied to this reorganization that Citigroup might face in the future? These are the questions for Citigroup. In addition to JPMorgan and others with the higher regulation, what costs are tied to that? What can investors expect out of Citigroup in this kind of second phase of Jane Fraser's restructuring? Because the first phase is showing that she is delivering, and she's delivering faster than she told you she would.
We did hear from JPMorgan that they are reserving more than $100 million for some of the additional reserves with respect to potential regulations. Citigroup is saying that they plan modest buybacks in the fourth quarter. Can we get a sense of who's most behind when it comes to regulatory capital and who can afford to go out there and do some capital returns?
Well, certainly this is a very positive story for Citigroup to be saying such a thing in terms of capital return. I think what's weighing on the banks is that longer term story in terms of what it's going to cost them once we start to see these rules start to take pace in 2025 and forward. Another thing here, you mentioned expenses coming in better than expected. Interestingly here, you've seen a lot of job cuts on Wall Street. It has felt very painful throughout the year, multiple rounds. The question is, if this environment remains muted, which it is, it's muted, not every business line is rebounding. This is sub $100 billion, $1 billion in investment banking fees we're talking about. This is peanuts in the scheme of things. Can they keep people on staff? Will that start to get more painful in this muted environment? We have escaped the worst for this quarter. That's what the banks are telling you. But when do things get meaningfully better?
What are modest buybacks? What does that mean?
It says they're going to give you some money back, but don't expect a windfall if you're an investor.
Okay, there we go. Thank you for translating. Appreciate it. Citi up by about 1.4%. Back with us, Ken Leon of CFRA. Ken, you've gone through Citi. What do you make of it?
This was a good quarter. It shows that there's a progression of the restructuring, and yet some of their core franchises, such as consumer and Treasury services, are doing quite well. So I think on an operational basis, we would give them an A. We also, for being courageous, Jane Fraser is moving ahead, as discussed, in terms of removing layers of management to reduce expense. And this is critical to get efficiency for this bank and to improve returns on capital. Lastly, let's not forget there's 9,000 employees at Citigroup that are working on a U.S. consent decree to improve their processing and regulatory regime for compliance. This is important. It sometimes gets lost in the weeds. But, for many years, Citi did not operationally have the best platform for surveillance. I think they're getting there. Looking ahead for the investor, you're always tempted with any stock in the large banks trading at half its net tangible book value when the others are well above par. And I think we need to see just a little bit more traction with what Jane Fraser does, not only with costs, but you need a successful IPO on Banamex in Mexico. As you recall, they couldn't sell it, so now they're going IPO in 2025. So things look promising, but they're still not, hitting on all cylinders.
Well, Ken, that's the problem. That's the question. Do they have a problem with expenses or with strategy?
I think the strategy is in place, and it does take time now to get the right people in place. That would be the management teams below the C-suite or the first layer so that they can execute on the strategy. We also are talking, again, this could be a conversation in 2 quarters of a very highly efficient global bank as they paired off all of their non-U.S. consumer banks, except for a few areas. So I think overall, there's still a lot of more work to do. And that means that what we've learned with the Wells Fargo turnaround is that they don't happen over 6 months. They take 3 to 5 years.
Ken, we saw JPMorgan just notch a record quarter of net interest income, $22.9 billion. They now see total full year net interest income of $88.5 billion. Citigroup also raised their expectation for their full year net interest income to $47.5 billion from $46 billion. Is the takeaway from some of these results that higher yields are now becoming a good thing for banks, a tailwind rather than a headwind?
So one scenario that hasn't been talked about, with the Fed possibly with a rate pause, is that with rates staying high, and if the banks can hold the line in terms of deposit costs, they can enjoy net interest income growth, particularly if there's loan growth. But one of the worries we have is that still 25 to 30% of total deposits are still non-interest bearing that can certainly shift and go to higher deposit costs. This is absolutely true in asset and wealth management for JPMorgan Chase, not so much a problem in the corporate areas where they have other reasons for keeping non-interest deposits in those areas.
But Ken, we're not seeing it yet. And this is something that a lot of people have pointed to, that these deposits have been sticky, that it is such a pain in the butt to actually move all of your money from one place to another and rebank with an entirely new institution, that people just are not doing it. What makes you think that people are going to start doing it, especially if they do start investing in other assets, and they haven't so far?
Well, we actually did see that again in asset and wealth management, down 8% on deposits. But in the other areas, I think you're right. It's a little bit stickier. There's lots of reasons for small business or sometimes for consumers, to keep those large balances in checking accounts.
Ken, I want to finish with the bond market if we can. Something Lisa and I have been talking about now for weeks. Do these banks need lower yields or higher yields? A long, long time ago, we'd catch up with people who would tell us forever that what they needed was yields higher, rates up, because they can become more profitable off the back of it. Ken, has that changed this year?
It really hasn't changed, but it's, for net interest income, which is very different than the bond conversation, it's loan volume growth. I think for the bond market, it's really what happens in investment grade that's so critical. Again, I want to see how many of these banks talk about getting to be balance sheet light, which means possibly partnering with private credit partners, given that they may have some portfolios that just don't make any more sense with higher rates.
So that means selling off loans, Ken?
Yes, it does.
Interesting. Ken Leon of CFRA, thank you, sir, for being with us this morning to break down JPMorgan, Citi, Wells Fargo. Shanali, what do you make of that final comment there from Ken?
Listen, it's the truth. The bankruptcies are rising. Torsten Slok is talking about it this morning as well. You have, at some point, the banks. You have Citigroup, $400 million in debt underwriting here. That is way better than expected. So they are making money by lending to corporations, but the big banks want to lean towards those safer corporations. And private credit can go clip their 14% yields here on those riskier companies if they want to.
But this raises a question of what these banks' roles are. Yeah. Are they the loan originators and then they sell them off to private credit? Are they going to de-risk and then become that much more utilities with just wealth management clients? Is that the model that we're seeing?
It's certainly the model that is being forced upon the industry. This is kind of an existential moment for the banks. Jamie Dimon wrote about it in his annual letter. What is a bank in the future? And
sounds like Jamie Dimon.
Right? Because you have their businesses having to change under the weight of regulation. You have Apollo, their deputy CIO of credit, telling me, Jamie Dimon says we're dancing in the streets, but we think we're dancing with the banks, which is his call to action for the banks to start working with these non-banks so that they can be the lenders ultimately and the banks can be the intermediaries.
I'm going to finish with a Tom Keene question in honor of Tom, who's not here today, but this is what he would say. Are they hiding how much money they're making? When you hear these bad headlines elsewhere,
I know, exactly.
Is it burying just how much money they're making right now?
Privately, even in the past week, the banks are certainly kind of concerned about the public backlash and how much money they're making in this economic environment, especially because we're watching them lean more towards those big companies, the big institutions. Credit cards, look at Citigroup. It's interesting. The spending is actually plateauing at this point, which that is, to me, a sign of strain on a consumer balance sheet. They can't keep maxing out their credit cards. How long is that going to last for? And how long are they going to be paying their banks 23% on interest?
Citi up by 2% this morning off the back of those numbers from JPMorgan and Wells a little bit earlier. If you are just joining us, welcome to the programme. On the S&P 500 right now, we are negative, down lower. We're off by 0.14%. In the bond market, I'm sure you want an update. We're down 8 basis points on a 10-year, 461.65. Blink and it'll change on a 30-year. Yields down by 8 or 9 basis points on a 30-year, Lisa, 477 after going through 5% last week, up 20 basis points at one point yesterday, then back down again. This is kind of crazy over the last few weeks.
And also to put into perspective, when we were sitting here yesterday morning, we were looking at 30-year yields that were down on the day, right? I mean, just to give you some perspective, and then it became the biggest one-day pop in yields going back to March of 2020 at the height of the pandemic. So you have to wonder, when we take a look at this market and understand the volatility, what's going to push it? Is it going to be the University of Michigan Consumer Sentiment Survey and inflation expectations?
I'm going to be long gone by the time you, Mitch, comes out. I'm not hanging around for you, Mitch.
You go on vacation.
Lauren Goodwin's going to talk about that of New York Life Investment. She'll be joining us at 8:30 Eastern Time. Your top story all week. Here's the latest. Israel calling for an evacuation of all civilians in Gaza City, giving United Nations 24 hours to move its staff from nearby areas. This headline just crossed moments ago, Anne-Marie. The United States working to establish safe areas in Gaza.
Yeah, they're talking with Egypt about this Rafah crossing. Also just crossing, Senate Majority Leader Chuck Schumer says he will be traveling to Israel this weekend. You're going to see a tremendous outpouring from the United States. We just had Secretary of State Antony Blinken there. Lloyd Austin is there today, and now we're going to have Chuck Schumer going over the weekend.
What was the phrase, standing shoulder to shoulder? It's been the phrase over the last few days, hasn't it? Coming up on this programme, Ed Yardeni of Yardeni Research, the man who coined the phrase bond vigilantes. Are the vigilantes back after the price action we saw yesterday? In the bond market right now, 30-year yields lower by 8 basis points, 10-year yields lower by 7 or 8 basis points at 462, and equity futures just a little softer from New York. Good morning.
I'm of a view that at some point in time, we're not there yet, but you're going to see some form of yield curve control brought in to stabilize the bond market. At the end of the day, financial stability is the unspoken mandate of the Federal Reserve. They talk a lot about unemployment and inflation, but when things really come to a head, financial stability is number one.
Is the US budget a financial stability risk? I tell you what, this conversation fueled so much feedback over the last 24 hours from both sides. Michael Schall there, the CEO of Market Field Asset Management. Hours after that conversation, we had a 30-year bond auction, which did not go too well. And we had a big move at the long end of the yield curve. Here's the price action right now on a 10-year. Then I'll get you to a 30-year yield. On a 10-year yield this morning, yield's down 8 basis points at 461.65. On a 30-year, Lisa, down 8 basis points this morning. At one point yesterday, a move of almost 20 basis points. But if you take it from the low of the session to the high of the session, the swing was more than 20 anyway. Ridiculous session.
I think it's good to point to that swing. The fact that we're not seeing any stability or resolution and that we're ping-ponging from one place to another from day to day shows the lack of resolve, the lack of understanding of what's behind these moves, and frankly, the lack of a consistent buyer base. And this, I think, was the point that we were hearing from with Dalip Singh.
It's the perfect day to catch up with this man right here, Ed Yardeni, president of Yardeni Research. And Ed, as I often say, but it's worth repeating, the man who coined the phrase bond vigilantes. Ed, you know me too well. You know the next question. Are the bond vigilantes back, Ed?
I think they are, yes, because it's certainly one of the reasons that the bond yield has soared from just under 4% on July 31st to over 4.5%, in a range really 4.5% to 5% recently. If we look at the 10-year, the 30 years have been higher. But supply clearly matters, and supply is a result of fiscal profligacy. It's fiscal policy is out of control. Monetary policy has actually been doing its job. I don't think the bond market or the bond vigilantes really have an issue with the monetary policy authorities. It's really, you can see they can't even get a Speaker of the House.
And sometimes supply doesn't matter. Typically in economic downturns, people will be willing to finance the deficit, buy Treasury bonds with exceptionally low yields. Ed, is this a situation that can be addressed with bad economic data? And what I mean by that is, will we buy this bond market? Will those auctions look better if this economy looks worse?
Well, for all the volatility we've had since the summer, I think we're clearly looking for a yield level at which the market will clear. And I think 4.5% to 5% should do it. So I think some of this recent volatility, as long as it's range bound, is actually a good sign that the bond market figures this is a good yield relative to the inflation outlook. I know there are a lot of people that were concerned about the inflation numbers, the CPI numbers that came out yesterday. But if you take out shelter, I always take out things that don't support my story. So if you take out shelter, the CPI headline and core were both at 2%, exactly at 2%. It's that, it's that shelter that's just way too blank too high. That's been the problem. And even in the latest number, it was a problem. But we know that lease inflation on new leases has actually come down substantially.
And I love that you said that. You take out things that don't support your story because it's what everybody is doing, and you can take out whatever data that you want and support whatever story you want to write.
Correct.
A lot of people are looking at the volatility of the bond market, and you heard Michael Schall yesterday talking about how something will break and that will be something problematic for the market that the Fed is going to have to respond to. Do you have the same feeling, or is your response the opposite, that the resilience that we have seen in risk assets to date in the light of such volatility is a sign that it can continue regardless of what the bond market does?
Well, I've been in the soft landing camp since early last year, and I characterized it as a rolling recession that's hitting different sectors at different times. And something is breaking right now, and that's in the commercial real estate market. There's going to be a lot of things breaking in the commercial real estate market. And I think it's one of the reasons the Fed is probably done raising interest rates, because they realize that the bond market's been recently doing all the heavy lifting in monetary policy. With a bond yield up close to 5%, that's a disaster for a lot of commercial real estate deals that have to be refinanced, or the value of commercial real estate. So those things are going to break, very reminiscent of what happened in the early 1990s when we had the S&L crisis. A lot of things broke in the commercial real estate market. We did have a recession back then, but it was very mild. It was just the growth rate that was really hampered by all those problems.
Let's tie that together because we heard from the Wells Fargo CEO saying that they do expect commercial real estate losses to increase. They are expecting loan losses to increase, even though provisions are not necessarily increasing as much as people previously expected. Is your sense right now that we're seeing things just soften and that we're not going to actually see anything break and that basically it's all been priced in based on where we are in this cycle?
Yeah, well, I'm still in that rolling recession camp. And indeed, in some areas, it's starting to look like a rolling recovery. I think in the retailing sector, for example, consumers may very well be coming back to buying some goods. The single-family housing market looks like it's bottoming. But yeah, I still don't think we're going to have an economy-wide recession going into next year. I think it's the economy's resilience is going to be proven to be with us. And I think it's largely because of the consumer. And there's a lot of moving parts in the consumer. One of them is you got 75 million baby boomers that increasingly are retiring. And talk about excess savings. I know Jamie Dimon has been saying since May of last year that consumers are going to be running out of excess savings, and that's when we have a recession. But the baby boomers have a lot of excess savings in their retirement assets, something like $75 trillion. And as they retire, they're going to be spending those assets.
Do those boomers not like Dom Perignon, LVMH, Ed Yardeni? Was that not the canary in the coal mine?
Well, look, I think that the retiring consumers are going out to restaurants. They're taking vacations more often. They're flying. They're using hotels, motels. And these are all the areas where industries are very labor intensive. And I think it explains why the labor market's been so tight. It's very hard to have a recession with a record employment. I know employment's always at a record right before recessions, but it just keeps going on. It just keeps rising to new record highs. So as long as that's the case, I think that the economy's resilience is going to be attributable to the consumer. And by the way, we know that the fiscal policy is out of control, but part of that is because they're spending a lot, which is stimulative to the economy. Even those net interest payments that they have to make, somebody's getting them. Consumers are getting a windfall relative to what they had, past several years of much higher net interest income.
You sound constructive, Ed. It's good to catch up. Ed Yardeni, of Yardeni Research on LVMH and consumer spending. Our producer just wrote in, what's the trade down from Hennessy? You see the spirit spending at LVMH? It was terrible.
Well, I
think
personally...
they were down 14% in that unit.
Do you like champagne?
Dom, yeah, sure.
Really?
Yeah, who doesn't like champagne?
Sure.
Lisa, come on.
Prosecco is way better.
Bramo, what?
I really
Prosecco is a little bit better because it's drier.
It's drier, and it doesn't give me a bad feeling in my stomach. I can't do champagne.
Okay.
Just letting you know.
Yeah, but Dom Perignon is not necessarily...
2013 Dom, we'll hook you up.
Yeah.
All right, thank you.
It's a good one. Anytime. Programming no in the next hour. No drinking. Mohammed El-Erian of Bloomberg Opinion, Queen's College, Cambridge, Julian Emanuel of Evercore, Tiffany Wilding, PIMCO, John Stolfus, Oppenheimer. If that's not enough, Tom Keene's panel coming up a little bit later as well. We'll take some of that in about 30 minutes. TK sitting down with 3, 4, 5 panelists, I think, 2 of which the IMF's Gita Gopinath and also the ECB President Lagarde. That's going to be an interesting one, Bramo.
Especially given the stagflation talk that we've been hearing about and the fact that I saw one note from Deutsche Bank today talking about a double-dip recession in Germany and the potential for real pain there. In some ways, Europe has been in the crosshairs of everything this year, whether it's the war with Ukraine or some of the spill-through from the turmoil in the Middle East. And that's really going to become at the forefront of her call as she talks about the euro and she talks about humdrum rates. She's got a real tough between a rock and a hard place kind of decision to make.
All of that coming up in the next hour. I can squeeze in this as well. Our good friend Sonali Basak taking over the reins of Bloomberg Real Yield. That's going to be very cool.
It's very exciting.
Is it still at 1 p.m. Eastern time?
It's still at 1
Good to know.
Do you remember when you ran it?
I do remember. How many months ago was that?
I think you started
I think it was at 1 p.m. It started at midday, then it went to 12:30, then I think it went to 1 o'clock, and it got moved around several times. But once we got to about 1 o'clock, I was like, it's getting a little bit late.
Yeah, especially because he'd have to really stick around for the University of Michigan sentiment survey.
I love sticking around for you, Mitch. What time is you, Mitch, out?
10 a.m.
I'll be straight out the door.
Oh, I know, 9:59.
Sonali, good luck. Looking forward to the programme. Thanks for your coverage.
I like talking about bonds. I'm happy to stick around on a Friday.
I know you do. You like talking about banks as well. More from Sonali on the latest earnings on Wall Street a little bit later on Bloomberg TV and Radio. Equities unchanged on the S&P 500. Bond yields a little bit lower this morning, down 9 basis points, 460.62 on a 10-year. This is Bloomberg.
This is Bloomberg Surveillance on a day of bank earnings. John Ferro off to his next property. Tom Keene is in Marrakesh. Luckily, Anne-Marie Herdern has not abandoned me, and she is alongside me, Lisa Abramowicz, as we carry you into 1 hour to the opening bell. We do get, of course, the earnings calls, 8:30 a.m. and about just now. We are expecting to hear from JPMorgan on their call. In the meantime, we are looking at basically completely flat S&P futures. Nobody knows where to go with all of the potential tumultuous action. We see the euro basically unchanged and the dollar as well. This is not a particularly exciting tape, 105.35. 10-year yields lower. This is where the excitement has been and continues to be. Down 9 basis points after yesterday, a massive sell-off in the price, increase in yields in the 10-year after a 30-year auction was really, really weak compared to expectations, even though yields were the highest at the sale going back to 2007. And a bid to crude, and we haven't talked about this, but Anne-Marie, seeing crude up more than 4.5% really speaks to the concern right now as we keep hearing all sorts of rumors. And this is a rumor mill, and we are not going to edify rumor, but real questions around at what point we're going to lead to some sort of massive escalation.
Well, CEO Jamie Dimon today talking about the concerns he has around the world, and he particularly talked about the food market, global grain, and energy prices. Because if Iran was to enter into this conflict, you're going to have some serious concerns on the energy front.
We will keep track of that for you as well. At the same time, in a day of a lot of action, we're nearly 1 month into the UAW strike against the 3 automakers in Detroit. We seem to be at a stalemate of sorts. UAW escalating the strike by walking out of Ford's most lucrative plant, the automaker saying its offer of a 23% raise is the best it can do.
We have reached our limit. We've actually stretched ourselves to get to this point. We're open to moving some money around within the deal that might fit the union's needs better. But broadly speaking, from an overall cost of the deal perspective, yes, we're there.
That was the president of Ford Blue. And joining us now, Bloomberg Detroit Bureau Chief David Welch. And David, this has been the question all morning. What's left? What are you expecting to hear at 10 a.m. from Shawn Fain?
Look, he's really been very unpredictable. We didn't expect him to walk out another plant in the middle of the week, and it almost seems like a tantrum walkout almost, where he just got fed up and left the table. And look, he could add more plants here to see if he can possibly get any more out of Ford or out of the other companies. But it really does sound like Ford especially, but the others' offers are not far behind. Everybody's kind of at their limit of how much they can spend on this next 4-year labor contract. And they have a fixed amount of money that they can raise their labor costs for the next 4 years. And they've got to be getting pretty close to it. So we'll see at 10 o'clock this morning if UAW President Shawn Fain thinks he can squeeze more out of them, or if maybe he's going to. I don't think we'll see a deal, but he could extend the current strike at the current plants while they just sort of finalize a deal if he thinks they're at the limit. Otherwise, maybe he adds to try to get more.
Ford officials said they were pretty shocked about the Kentucky plant. Did he pull this wild card too soon?
I don't know if he pulled it too soon. It almost seems like there was a misunderstanding between the two of them, or they were talking past each other maybe, because Ford said they made it clear they couldn't add to the economics of the deal. And he said, Shawn Fain, that is, said that the union was expecting to add, that Ford would add more to it. They're at a 23% pay raise over 4 years, plus a cost of living allowance, plus some add-ons to the retiree benefits for the workers, not a defined benefit pension, but adding on to those retiree benefits. The open question is, what's Ford going to do for future battery plant workers? Will they automatically be part of the union and pulled into this master agreement? Will they be paid the same? That could be an area of disagreement. But Fain was specific that it was economics. And look, this is a very rich deal as it stands from all 3 companies right now, and I think it would be ratified pretty easily. So I'm not sure how much farther the companies will go. And Shawn Fain will either have to accept it or we're going to have to buckle in for a longer, nastier strike.
David, how can they promise workers jobs at battery plants that they don't even have yet?
It's complicated. There is some precedent for it. Ford had a plant in Michigan years ago that made dashboards, plastic parts, and that sort of thing. And before it opened, Ford agreed that it would be part of the national agreement. But you still do have to organize the workers. Basically, companies can pledge what they call a card check or a neutrality promise, where if half the workers simply check a card saying they're interested in the union, the company will automatically recognize it. And then the company can extend whatever wages and benefits they want to those workers once that's done. It's tougher to do in right-to-work states, particularly in the South, particularly in Tennessee and Kentucky, where Ford has a lot of manufacturing and where they're planning a battery plant. So it'll get very interesting to see how that's going to work out. But I think what the union wants is for the companies to automatically recognize these plants and then give them these master agreement wages once they get there. And I think that's where the fight will be, because EVs don't make a lot of money. A lot of them lose money, and promising top level pay and benefits to make batteries for vehicles that are losing money right now. I think you're going to see a wrestling match over that.
Bloomberg's David Welch, thank you so much. And I'm sure we'll speak with you soon to get the latest. Meanwhile, we have been getting bank earnings throughout the morning. They have been beating across the board, and we have seen record net interest income at JPMorgan, similar types of expectations for that to continue at the likes of Citigroup as well. Joining us now, Lauren Goodwin, economist and portfolio strategist at New York Life Investments. Lauren, what's your take of what the read-through is from the banking earnings we've gotten so far on the rest of earnings, and frankly, on just the role of banks for investors that have been underweight so far this year?
Well, the bank's earnings are telling us, frankly, what we already knew about the economy in the third quarter, which is that we are seeing some early signs of weakness in low-income segments of the economy. But overall, things are okay. We have to keep in mind that bank lending conditions and monetary conditions have been tightening for 18 months already. And so the likelihood that we saw a meaningful surprise here was relatively low. Now, if I expand that to the broader economy and earnings for Q3, I expect we might see more of the same. We know what's been going on in the real economic data, and earnings expectations have already been revised down fairly meaningfully, especially in cyclical sectors. So I think we may be able to see an average rate of beats, and recession just is nowhere to be seen yet.
So are you getting more bullish as you see some of these results?
On the economy, no. And that's because when we see the Fed raise interest rates, the economy tends to evolve in a very similar level. And what I'm seeing in the data and in the markets are signals of late cycle economics. However, until we see signs that recession is already here, the equity market doesn't tend to react to that. And so rising unemployment claims, earnings deterioration, those are the signals that I'd be looking for to get much more bearish in the equity market. They're not here. And so it's an environment where, while we may expect a little bit of sideways activity, lots of volatility, it's one in which it's important to be invested.
So it's sort of dancing in the twilight, basically trying to get to a place where you are capturing the dynamism of the near end of cycle or late cycle that you're talking about. It's something that other people have been talking about too. Are banks still leveraged to this economy, or are they independent? I'm talking about the biggest banks. Can you get long banks even if you see some sort of downturn in the near future, simply because they can capture the upside from higher rates? And they've been insulated from losses to such a degree with a lot of the regulatory action.
Well, two things are important here. First, absolutely, the banks are still leveraged to the economy. Because bank lending standards have been tightening, because they expect the economy to slow over the next several quarters, you do see revenues starting to slow. That's because loan origination is down, and the cost of deposits is going up, and the competition for those deposits is going up. For the big banks, though, and this is the second thing, they're diversified. They have fortress balance sheets. They have a lot of ability to navigate cycle dynamics as differentiated from smaller and regional banks, where that scale is less beneficial.
How much are you concerned about potential paper losses from bond yields rising as much as they have, and the volatility that we have continued to see? Have we seen the fallout from that? Or is there something that sort of feels ominous about what we've seen?
Well, the reality for the banks is that the Fed's term lending program is still intact and will be until next March. And frankly, if long rates are still high, as I expect they will be in March, that program would be, I think, likely to be extended. And so paper losses in terms of a risk to the broader equity market are not on the list. They're not a concern. Where they do play a role is in capital considerations for the banks. And that's, of course, something that we're going to be hearing. Well, maybe we won't actually hear so so much about it yet today because the banks don't really know what they're going to look like. But that's an area where we expect to see some continued hemming, hawing uncertainty. One thing with respect to capital and increasing capital regulations for the banks is there is a bit of a point here in that capital is so important for the security stability of the banks. It's one of the reasons why the big banks are able to navigate these dynamic forces that we're seeing in the market. But what we saw in March was a lot more about liquidity. And so I'll be curious to see what the banks say about that balance of capital, fortress capital amounts, and then the liquidity of that capital in the future.
We've seen a lot of volatility in the past couple of weeks. Have you changed anything about your views?
Such a good question. We're vigilant in navigating the market, but I think the reality is until we hit recession, we are probably not going to see a definitive macroeconomic narrative driving the market. And as a macro person, what that means is this is a time to be thinking about quality, essentially hand things over to the stock pickers, hand things over to the bond pickers, and acknowledge that sector or style plays are unlikely to last more than a few days at a time when there's so much uncertainty.
You say you're encouraging investors to be very pragmatic and kind of stable at the moment while they look around what's going on geopolitically. What did you learn from Russia's invasion of Ukraine that potentially you want to keep in mind when we watch these events unfold in Israel?
Well, the number one thing that investors, I think, felt in real time with Russia and Ukraine is that the initial shock, the initial assumptions that are made about a geopolitical shock or narrative aren't always what drive the market in the medium and longer term. So the first couple weeks after the invasion, you saw proximate asset classes seeing the most impact. The Russian ruble, Russian equities, oil, some food commodities that we knew were relevant in the region. But 2 weeks later, the most impacted asset class was the German Bund. And that's because the narrative around the invasion became one of inflation, one of a broader global picture that geopolitical risk was entrenching rather than just that initial shock of oil. And we've seen the same thing this week. A little bit of a bid in oil prices on Monday. That's reversed a bit as markets step back and assess, okay, what really are the implications of what we're seeing in Israel to the region? So far, there hasn't been a meaningful impact to energy supply. And I think that's why we've seen some relief of that story. And then again today, with concerns that there might be an escalation, of course, the geopolitical picture changes. But there do tend in these shocks to be a stronger narrative that becomes clear. We just have to wait a little bit and see what happens.
And markets tend to be very patient. Lauren Goodwin of New York Life Investments, thank you so much for being with us. If you are just tuning into the program, the S&P is basically unchanged as we kind of fluctuate here. But now we are moving up 0.2%. We are seeing that yields now are down 11 basis points on the 10-year. 458.56. We are getting some headlines from the JPMorgan conference call with investors. So with us, Sonali Basak, going through some of what we're hearing. What are we learning, Sonali?
We are learning that he is still criticizing regulators. We knew that this was going to be happening, and we've been talking about this, the storming of the Hill. The banks are really fighting these capital requirements, this new Basel III endgame requirements. And as we know, those big banks, they're not going to even be impacted as much as those smaller banks. That is a big part of the story here. I've been looking back through his prior comments as well, this idea of how much things can get worse. What's interesting is this is the best third quarter that Citigroup has ever had in rates and currencies. If you look at that at JPMorgan, they beat on expectations, remember? But the value at risk being a little lower, Lisa, is telling you something about the risk appetite within these banks as the economy starts to get a little choppy here.
We will get a little bit more, or much more detail coming up with you. Anne-Marie, from your perspective, is there any appetite in Washington, D.C. to divert focus to scrutinizing banks more, given the fact that they need to get leadership and deal with a whole host of other
Well, it depends
issues?
who you ask. But to Sonali's point, Jamie Dimon has been talking about this for months. When Michael Barr came out and talked about stricter capital requirements, he said, great, this is a win for the hedge funds. This is a win for Apollo. This is a win for, and private equity firms. So this is a concern for the banks. But at the moment, the Fed looks like, and the regulators look like this is what they want to do. Because how do you have the past 6 months, we had 3 bank failures and not act?
Right, especially with smaller banks, which might have the harder time actually developing some of the capital. Coming up, we will dissect some of these headlines, including the CFO of JPMorgan saying the pace of buybacks likely modest on capital proposal. Basically, modest is the word of the day when it comes to share buybacks, yet they will continue.
Once scenario that hasn't been talked about, with the Fed possibly with a rate pause, is that with rates staying high, and if the banks can hold the line in terms of deposit costs, they can enjoy net interest income growth, particularly if there's loan growth.
That was Ken Leon, Director of Equity Research at CFRA, after JPMorgan posted yet another quarter of net interest income that breached records, $22.9 billion in the third quarter, raising their expectations for the full year forecast. Similar type of move from others as well, and we are seeing that play out in the stocks as we see equities do better, especially in the banking sector. You can see JPMorgan Chase shares, which once were fluctuating about, now 1% higher as people parse through the results and get a sense of how much better. Also a sense that we are going to get share buybacks, although modest seems to be the word of the day. Wells Fargo shares up 2.7%, a beat across the board. Really, again, it's loan loss provisions that are lower than expected. It's net interest income that is higher than expected. It's banking revenues that are higher than expected. Fixed income trading revenues that are higher than expected. Equity is the weak spot, and yet still the incredible strength is leading these shares higher. Citigroup shares also up 2.7% on the heels of this. Anne-Marie Herdern here with me. John's off preparing for the 9. Sonali Basak has been parsing through the numbers, listening to the call for JPMorgan because she can do everything at the same time. And I'm wondering if there are any larger takeaways before we dig into some of the details from these earnings that we can kind of draw a conclusion on with respect to the banks.
Yeah, there's one thing that JPMorgan says that I think is very important in terms of caution for the industry that is so excited that things aren't so bad today. And he says these results benefit from our over-earning on both net interest income and below normal credit costs. What does that mean? Don't expect this to be normal per se. He raised his net interest income at least 3 times. There's a debate if it was a 4th time this year. And can you imagine to that many times say, we're going to make more money, we're going to make more money, we're going to make more money, and we're going to make more money.
Well, okay, but here's the thing. There's a bigger takeaway here, and John was asking this earlier, which is how much is this PR? And basically saying, don't look at us. We're not expecting to make this money. It just keeps coming through the door. Or is this something that is some sort of tea leaf of what they expect to come, and saying to regulators and saying to others, hey, it's not so great. We're not really making bank. It's just sort of a quirk of the moment.
There is a little bit of balancing here. Remember, they are taking to Washington again soon in early December. You have the big banks that will be facing lawmakers at the beginning of their annual grilling. I love listening to this one. Because they are making pretty stunning profits in this environment. But they can also say, this is the U.S. consumer. This is a good thing. The consumers want to borrow. They're still spending money. You are seeing some normalization. Look at Citigroup, the kind of the spend here starting to normalize. These are things that show you things could start to turn a little bit here. But the strength of the consumer is keeping the banking industry strong, plus the comeback of these institutional businesses that are aided by these very complicated dynamics in the market.
They're going to really push back on potentially future bank capital requirements, aren't they, when they come to Washington?
There's going to be 2 objectives. From the banking perspective, they're going to be pushing back against those capital requirements. From the lawmakers' perspective, there's all sorts of other issues. Why aren't you lending to my constituents who want to buy a home? The housing market is still in dire straits in many places in the country. There's going to be that constant push-pull on ESG matters, especially with this concern about energy security around the world. There's also going to be a lot of questions about headcount, because besides for JPMorgan, most of these other banks are cutting jobs, not adding them.
One thing that you really should need to know about Washington when there's hearings like this is actually you think lawmakers in the room listening to every question, listening to every answer. They're actually not. They come in, it's very performative. They decide the point they want to make, potentially try to embarrass an executive, and then they leave.
Don't you just kind of want to go down there and buy them all a drink after? Like, it is such a long day. But, speaking of long days, this sets us up for next week, too, doesn't it? Because we do have Goldman Sachs, Bank of America, and Morgan Stanley starting to come in. Remember, what's interesting, a lot of money, yes, the consumer's holding up. The economically sensitive parts of the economy, as you see at Wells Fargo, auto lending, homes, still under pressure. But when you look to Bank of America, Morgan Stanley, these are wealthier client bases that we're looking at here that are borrowing for homes and still able to spend at maybe a greater scale than you're seeing at the weaker parts of the economy.
One thing that the JPMorgan CFO said on the call was that, as you mentioned, the full year net interest income guidance was up on, as you mentioned, Sonali, slower reprice. Does this basically just mean that they are not passing it along as quickly as they thought they would be to depositors?
And this is where that big versus small question comes into play again. JPMorgan is not passing it on as meaningfully as some of the smaller banks, where, Jefferies in particular puts out this great chart about just how much deposits have repriced, because across the industry, they certainly have, just not at the biggest of the big banks that don't need your deposits.
So at what point does that become some sort of rallying cry? If you're getting so much money, why don't you pass it along to some of your clients that you have? At what point does that deposit beta play a role and really come under focus?
And it's also that question for consumers. Do you park your money in a JPMorgan where you know your money is safe, too big to fail, right? Or do you park it at a smaller bank where there could be some more worries, as we've seen earlier this year? Those smaller banks are getting a better rate on your deposits. But to your point, too, this has been highly politicized. The bankers have been directly asked, where is this money going if we're raising interest rates and you are not giving that money back to consumers?
Which raises the question of modest buybacks. And modest has been the word of the day. It's sort of, something that we've seen as a theme in a lot of the banks. How much are we going to see in terms of buybacks? What will count as modest enough to satisfy investors and quell concerns by regulators?
It's a great question, because the banking investor story, I don't know that it's hinging necessarily on those buybacks. They just want the numbers themselves to get better. But to the point you're making also, you can't sit there and return a ton of money to investors when you're laying tens of thousands of people off at most of these banks, right? The expense story and the use of capital is a massive tension, and only getting more so by the day, because wage pressure still exists at these banks too.
There's also a big theme, especially as we head toward Morgan Stanley, Bank of America, and Goldman Sachs next week, about why equity trading revenues disappointed and fixed income revenues beat. Do you have a sense of what was behind it? Is this a theme for the industry, or is this an execution issue for both Citigroup as well as JPMorgan?
There's one big tell that shows you that this is a theme for the industry. You had three of the biggest investment banks in the world, Goldman Sachs, JPMorgan, and Morgan Stanley, on the Birkenstock IPO, and the IPO whiffed. And so that is a really big problem for the IPO market. This lack of equity issuance, this real scarcity here makes it tough to keep equity trading live in terms of fees for the banks. But, a little inside baseball, that Goldman number versus Morgan Stanley next week is the talk of the town. Goldman has been leading on financing the big hedge funds and trying to win that business. Leverage, while constrained, is still alive and well.
Sonali Basak, thank you so much. We'll be catching up with you throughout next week and throughout the day ahead. And of course, we're going to get those earnings from Bank of America as well as Morgan Stanley and Goldman Sachs next week. Anne-Marie Herdern, first, I just have to say thank you so much for being with us this week.
Thanks for having me.
Because it's always wonderful to have you. It's also such a pivotal moment down in Washington, D.C. and just globally. And I'm wondering what you're looking for, just sticking domestically for the moment, to understand whether we can create some sense of order in terms of even nominating somebody to take over from Kevin McCarthy as Speaker of the House.
I think it's pretty obvious the Republicans at this moment are struggling to coalesce around one name. Steve Scalise, who had the majority in conference, couldn't get to 217. They can only lose 4 votes. And at some point, if this continues to drag on, you have to think, is there going to be a centrist that comes out and says, I'm just going to reach across the aisle, give the Democrats something they want potentially in a ruling coalition, and then we have to get a speaker and we have to move on.
You mentioned about the bank hearings on Washington, D.C., and you can see that actually any video shows that people come in, they make a point, they say something, they clip it, they put it on Instagram.
Very performative.
Right, they put it on Instagram and then they go home. And there's a question of whether Washington is losing relevance and whether they understand that. Do you get the sense that people are watching in Washington the perception and some of the market moves in response to what they're doing?
They watch perception, I think, more to their constituents back home. Obviously, they're always concerned about what happens in the markets if you're on the Financial Services Committee. But I would say that while, in New York, people will ask me, well, why can't they just get this done? It's just not how Washington works. Someone in New York, they're thinking in a pragmatic way. I want to get to a bottom line. I want to maybe make money. That's not how D.C. works. Things just take a lot longer.
Which is the reason why a lot of policymakers are getting together and trying to figure out whether at least maybe internationally they can coalesce around something. And that is why Tom Keene is in Marrakesh, sensibly, although we will be hearing a fantastic panel that he has coming up at 9 a.m. Tom Keene is sitting down with the IMF's Gita Gopinath, ECB President Christine Lagarde, and the WTO Director General at the IMF meetings in Morocco. You can watch the conversation in its entirety on Bloomberg at LiveGo. Right now in markets, we could see a little bit of a positive momentum as we see better than expected bank earnings across the board. 0.3% gain on the S&P.